To be done, even as markets price in a pause in September. The 10-year currently at 4.09. Not a lot of movement there. Brent looking at closing the week, 7 straight weeks of gains now for oil. It is down the session though, 0.4%. Let's have a look at how futures are squaring up then as we weigh up the UK data, the growth data, that surprise strength that's coming through, the surprise resilience despite the pressure on households here, and of course the more benign inflationary picture out of the US. DAX futures pointing to losses of 0.3%. The FTSE 100 futures pointing down by 36 points, and the CAC current off by 38 points, down 0.5%. It was a negative session in mainland China and Hong Kong as well. The concerns about the real estate market really weighing on mainland stocks there. So that is also something of a read across for these markets. The FTSE 100 then, just in the first few seconds, the question of course is whether a more resilient economy gives more dry powder to the hawks on the BOE. Will they have to go further in terms of rate hiking? We heard from Charlie White-Smith over at Saxo UK saying that he sees 5.75 in terms of the terminal rate for the Bank of England by the end of the year. FTSE 100 now down 0.5%. We continue, of course, to see how pricing reflects across these other major indexes over in France and Germany. There we go, the CAC current down 0.6%. Over in Spain, losses of 26 points. Across your sectors then, let's flip the screen and have a look at how things are reflecting. We talked about the oil story, the energy story, how does that bump up in gas prices earlier this week. That came off a little bit, and then again, in terms of the gains that you've seen in terms of Brent, WTI, 7 straight weeks, gains of about 20% just in the last 30 days or so. Technology is down 0.7%. Basic resources off by 0.8%. Every major sector that we're monitoring here this morning in the red. So a little bit of negativity coming through these markets despite the strength in the UK economic data and of course a softer picture when it comes to US inflation. Energy off by 0.8% and industrials down by 0.6. That is the read across these sectors this morning. We'll check back in, of course, across this hour. For now, let's bring in Sam Unstead from our Markets Today blog. Sam, you've been passing this UK data. You've been looking at what's been happening in China as well. What is standing out to you in terms of the potential market-moving implications of UK PLC and the relative resilience, relative strength that we're seeing here?
I think in terms of the GDP data today, the main move I think is in the pound. Where I think it then becomes interesting is how this reads into what we're going to get next week, the very important data next week with jobs data and inflation, and then whether that starts to feed into a different narrative for the Bank of England. I think at the moment there's a pretty strong consensus with the Bank of England that we're going to get a 25 basis point rise when we come to the September meeting. The uncertainty is beyond that, and it's how that feeds into that incremental story about the UK economy.
One big corporate story for us today, of course, before we get your views on China, Sam, is UBS. We're just going to check on the stock price because you're seeing a pop there, and this is something, of course, we flagged in the 7 hour, the expectation that you would see a rally in UBS shares on the back of their decision, and it was a surprise decision to voluntarily end and move away from this backstop that had been negotiated with the Swiss government after it took over Credit Suisse, a backstop of around $10 billion US. And the expectation, the suggestion then from this decision that actually the assets taken on and absorbed by UBS, those Credit Suisse assets, are not as challenging as maybe executives had feared. They do not see the need for this backstop, this $10 billion equivalent backstop, and they have decided to voluntarily cut themselves off and terminate that backstop. And again, the view then, investors rewarding UBS for this, up 4% currently, 3.9% on the back of that news. The assets less challenging, it seems, that have been absorbed by UBS from Credit Suisse. Keep us across this story for you, of course, and get the details throughout the next few hours. Sam, when it comes to China, there was some interesting news in terms of Beijing's attempts to try and address some of the liquidity constraints, the debt challenges at the local level. Local governments in China have really faced the pressure in terms of the inability to sell large tracts of land. Real estate prices have come off, the debt pile has continued to pile up, and now Beijing is taking some form of action, at least.
Yeah, and I think the question here is the same question that we're getting every single time that some kind of move is made, right? By authorities in China and by policymakers there. Is this going to be enough? You know, is this going to really solve the issues? Certainly, it seems like what they're going to do in terms of taking some of the pressure off of local governments in the country will solve part of the issue that they're facing. Whether that's enough, and certainly whether that's enough to have any kind of impact on asset pricing in China, we shall see.
Yeah, whether or not it's just a shuffling of the deck chairs when it comes to the debt picture in China. Sam Unstead, thank you very much indeed. From our Markets Today blog, you can get more from the team on the front page of the Bloomberg UK website or by typing TLive Go on the terminal. Let's check in on some of the individual stocks on the move with Joe Easton. We flagged UBS. Another interesting story is Telecom Italia and its deal making with KKR. Joe.
So UBS, first of all, the best performing stock on the Stock 600 today as they agree to end that backstop agreement with the Swiss government. Now that is spurring hopes that some of the losses from Credit Suisse will be smaller than expected and pushing that one up. As I say, the best performer on the European index today. Not got a price yet on Telecom Italia, but that was looking positive according to analyst notes, given that the Italian state will be part of that takeover and potentially will help that deal get approved with KKR for their grid business. Now, Metro AG, the big German wholesaler, reporting a return to profit, but sales came down once again. A lot of the weakness is in Russia. I was speaking to Charles Allen over in Bloomberg Intelligence. He ran me through that and said it's Russia where the big weakness is, given the economy coming down there and then pulling out of some regional parts of that business. So that one was called sharply lower, just flipped positive or unchanged at least. This is the German steel company. We had a report from ThyssenKrupp yesterday, which was probably positive, but this one not so positive. That one actually had a decline in some of their earnings, but as I say, unchanged. Telecom Italia then, just been told in my ear, and there it is on the screen, up 5%. So as I say, people thinking that this will help that deal get approved, given the Italian state are on board, KKR taking over their telecom unit grid. We're going to flip over and look at some of these UK stocks following the GDP numbers. So GDP coming in better than expected. As Mark was saying, a lot of the other smaller numbers like manufacturing, the high frequency data, much better than expected. But what that means is we're seeing a rise in UK gilt yields today, and that is bad for home builders like Taylor Wimpey, because it means mortgage rates go up, demand for housing comes down. So we're seeing Taylor Wimpey decline by about 0.5 percentage points. Lloyd's up 0.3%, the most exposed UK domestic bank. So it's a mixed picture. The economy doing well, rates coming up, not so positive anymore for the UK banks. And next, the retailer coming down slightly. I think it's all about rates. Will it mean Bank of England rates stay higher for longer? Will that reduce spending on the high street at shops like Next? Now, I've brought up EMIS as well, completely different. The UK authorities, in terms of the CMA, the competition authorities, has approved a takeover by United Health for this company. There was uncertainty over whether this would go through. This is a software company that sells into pharmaceutical companies and also actually into doctors' surgery. So GPs use their software. That one rocketing 25%, the best performer in the UK market by some way. Finally, looking at ratings changes as usual, UK lender HSBC gets that price target upgrade over at Citi, but we're not seeing a huge reaction there. Perhaps the rates issue taking more of an effect following that UK data. That one was 8.30 in terms of their price target, still trading well below that at 6.29. GlaxoSmithKline, their price target is cut at Citigroup, who are factoring in a potential payout from Zantac, this drug that potentially causes cancer, and Glaxo is going to have to pay out several billions of dollars for that issue, according to most analyst expectations. In terms of Novo Nordisk, still on track for the best week ever, the best week in its history as a listed company following that Wegovy update. But they get a downgrade over at DNB over in Norway, who say that Wegovy estimates will have to come down following yesterday's report from the Danish pharmaceutical giant. And finally, finishing off with a bit of pizza, a slice of pizza, Domino's Pizza. Well, that one, taking a slice out of those shares. That's Deutsche Bank, downgrading that one to hold. They say the company will probably weather the recession, given they have room to bring their prices down, but the valuation has gone too high. It's up 40% over the last year, and Deutsche Bank cuts Domino's to hold.
Joe Easton, a little bit cheesy, but I like it, from our equities team. All right, let's check in on gilts. You talked about the fact that higher rates, of course, are rippling through these markets. Good news is bad news kind of scenario playing through for at least some parts of the UK asset space. And yields are up sharply, fairly sharply across your gilt curve. 7 basis point move higher at the front end on the 2-year, 497. So closing in on that 5% level at the front end. On the 10-year, 443. That is also a move higher of 6 basis points. So yields up, gilts selling off on the back of this stronger economic data out of the UK and expectations that the BOE will have to go further. The pound is also gaining, currently up at 127 versus the US dollar, a gain of 0.3%. Coming up, we're going to have a look at what 2 months in a row of tame US CPI data means for that economy and the Federal Reserve. Can we now assume that September is a pause? This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. Tuesday, in his first international media interview since becoming Taiwan's vice president, Lai Ching-te speaks to Bloomberg exclusively about his presidential run and managing relations with the U.S. and China.
Taiwan security is a global issue, and the peace in the Indo-Pacific region benefit all the country.
What kind of leader would he be? What are his plans for Taiwan? And what would they mean for the world? Tune in all day August 15th, only on Bloomberg, your global business authority.
This is Markets Today, 12, almost 13 minutes into the European trading day. A little bit of lacking optimism across these European equities, currently down 0.5% across the benchmark. The standout data print for us today after the CPI of yesterday, of course, was the UK data, which came in much stronger than expected. When it comes to that US CPI print, softer, so that narrative around softer inflation, particularly when it comes to core inflation, continues to build in the US, and there is an expectation now, markets pricing in a pause in September, even if you continue to hear some voices from the Fed suggesting that the work from the Federal Reserve is not yet done. A couple of individual stocks to bring to your attention, but before we do a deep dive on all things currencies, we do want to focus in on UBS and Telecom Italia, the two leading stocks across European equities this morning. A rally there for UBS of, look at that, 5.6%, almost 5.7% on the back of that surprise decision to walk away voluntarily from a $10 billion equivalent backstop from the Swiss government that it had negotiated as part of its takeover of Credit Suisse. And the read-through then is that the asset quality, it seems, from that Credit Suisse takeover that UBS has had to absorb, that maybe there is less of a challenge there and therefore no need for that backstop. So investors rewarding UBS on the back of that surprising move. Telecom Italia, interesting in terms of getting deal making across for parts of that network of the business. KKR and the Italian government in the mix. And again, investors pretty happy with the developments there around Telecom Italia. That stock gaining 2.7%. Let's get back, though, to the macro data and how it feeds into the FX space. Very pleased to say I'm joined by Mimi Rushton, co-head of Global FX Distribution at Barclays. Mimi, good morning. Thanks for joining us in the studio. Before we get to the US, let's start on the pound, because we're seeing a pop there of around 0.3%. The data coming through stronger than expected. Do you expect the upside for pound to continue?
It's really interesting to see this data this morning because it coincides with what we've been hearing from our clients, which is that actually UK activity is pretty robust. But what's, when you put that into context around positioning, actually investors have been a little bit more bearish on the potential outlook for the UK and for the pound. And it's really this kind of dichotomy as to whether you're going to see interest rates go too far up. And, the stagflation narrative hasn't necessarily gone anywhere. But that being said, I think there's room for the pound to potentially see some gains here. Our traders prefer to see it through euro sterling as opposed to in sterling dollar terms. But yeah, as I say, it kind of backs up what we've been hearing from our clients, and in particular on the corporate side, the consumer continues to spend. So our house call is just for one more interest rate hike, but clearly we'll look to CPI next week and see whether that adjusts things yet further. Okay, so you play potential upside for the pound via euro pound, euro GBP as the cross. What's the next level that you're looking at for the pound? Well, we've traded this range of 85 to 90 for as long as we can probably remember in recent history. I think calling it down to 85 is pretty aggressive, but maybe 85.5 is somewhere where you would potentially target. Our clients certainly on the corporate side would love it to get down there. It would help certainly with their potential exposures, but it kind of depends on what we see out of that inflation print, but also what we start to see out of the activity data in Europe, which frankly has been a little bit disappointing, but somehow the euro continues to perform. You're very negative on the euro. I mean, yes, the data's come through softer for the eurozone, but the hawks continue to reiterate the message that more needs to come through from the ECB, and there is the argument that there is a catch-up at play that's needed between the ECB and specifically the Fed, of course. I think very negative is a little bit of an overstatement, but thinking about how the euro has performed, there's no doubt there. You've been talking about it for the last half an hour in terms of some of the noise that we're getting out of China. But European data, if you look at US versus Europe surprises indices, it's clear that Europe has underperformed, and yet we're seeing Eurodollar perform well. And actually, one that I would call out today for those watching is Euro Yen at 15-year highs. It's really interesting to see the euro perform the way that it has this week. So you play euro weakness through euro yen? Well, I'm not sure about that. I just think it's topical. It's really interesting to see that level and really play out from a euro yen perspective. Clearly, yen is more of a carry play, and we know that there's been plenty for us to focus on this year around. Do you think it goes through 145 versus the US dollar? Well, I think that's where everybody's focused. I think it has to probably go there before we start to see signs of potentially verbal and then even more intervention from the Bank of Japan. But if we're here, you've got to assume that dollar yen has to play catch up, given what we're seeing in euro yen. On the dollar over the last 30 days gaining about 2.5%, despite the fact that, again, the inflation suggests that we really are in a disinflationary environment now in the US, and therefore the Fed
can start to consider a real pause. Help us understand that dollar strength that's come through in the last 30 days.
Well, I think the first thing is that the dollar obviously trades with risk as much as it does about what's happening in the US economy. And if you start to think about de-risking, clearly the dollar benefits as well. It's actually hard to construct a narrative where you see significant dollar weakness when most of the market is trying to anticipate where this global growth slowdown will come. And you're getting data, as we've said, out of China and out of Europe, which suggests that actually things are potentially turning. Actually, our clients are starting to get a little bit concerned as to whether this idea of a soft landing is being overplayed. And, you know, they're going to focus their attention from looking at inflation to other activity data. You know, what's happening to consumer confidence? Are we seeing spending continue in the way that you would expect in that soft landing environment? And actually, probably the risk that's underpriced is that the landing's going to be much harder than anticipated.
And if the landing is indeed much harder and the markets are getting it wrong, and that has been the consensus over the last few weeks, moving to that soft landing view on the US recession and the US economy, does the dollar become a safe haven, or does it show vulnerability in that scenario?
Well, I think that's the issue that our clients are grappling with, is sort of how do you play it? Maybe it's not about trading the dollar at all. Maybe it's actually about thinking about other crosses, you know. Carry still very much is king. We've got another 3 weeks at least until Jackson Hole, where we sort of, or through Jackson Hole, where we start to think about trading carry tactically and taking that opportunity. But beyond that, you know, you could see a scenario again where the dollar, as you say, takes on the safe haven status rather than it being about the world growing in tandem. So, you know, taking the dollar leg out of it, thinking about it through other crosses, I think is the way forward.
Okay, carry still king, and the way to play the pound then is euro pound. The view there on the sterling, of course, on the back of that data. Mimi Rushton, co-head of Global FX Distribution at Barclays. Thank you very much indeed. Coming up, UBS shares soar after Switzerland's biggest lender ends its agreement with the Swiss government to cover losses, potential losses it could incur from the rescue of Credit Suisse. We'll get the details next. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis, we're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Welcome back. This is Markets Today. 23 minutes into the European trading day. You're seeing losses of 0.4% across the European benchmark. One stock that's doing very well this morning, though, is UBS. Shares climbing. Checking the price now, up 4.3%. That after the bank, of course, decided to walk away from a backstop, $10 billion backstop, that had been guaranteed and negotiated with the Swiss government. Francine Lacroix, of course, has been across this story from day one, joins us for the details. Francine, how much of a surprise is this, and what does it tell us about how UBS is working through this? We are reunited. That's really the headline for us.
That's really the headline. But UBS actually doing great today, right? 4% higher. And I wonder what investors are looking into this. Now, this is a big deal because basically, remember that weekend we were all on tenterhooks trying to figure out exactly why they were buying it, and especially what Credit Suisse had in the investment bank unit booked in London that could have been ugly. So the fact that they say, look, thanks for the guarantees, we don't need this, means that they've gone through the books. They had until, I think, mid-June to go through that, and that they haven't seen anything materially ugly. So this is something that investors will, of course, take relief in. The other story is that, look, once you have that guarantee, the government, you're in the headlines, right? For the government, they also have an election mid-October, and so it kind of removes them a little bit from the government. So I guess it gives them that much independence for whatever they announce August 31st.
Yeah, that's interesting. So the politics of it, and we know this wasn't received well amongst many people in Switzerland, the fact that this backstop being provided, and Swiss ministers coming out this morning saying that basically voters are no longer on the hook, right? What else are you looking for then in terms of how this story develops from here?
So the big day is really August 31st. So I thought the timing today was interesting because they could have just announced it August 31st. We'll, have earnings. We'll probably have an update, of course, on the merger, on some of the big decisions that they have to take. And they could have then, at the time, said, look, we no longer need government guarantee because this is the books in Credit Suisse and we're not going to book a loss on this. So that's what they could have done. The fact that they do it 2 weeks before makes me wonder, but this is, speculation, are they going to announce something big? Is it something that actually, they want that independence now? Or is it really them trying to remove themselves from the public headlines? Again, and we know it here too, NatWest, partly owned by the government, with not interference, but certainly comments and ministers constantly being asked about this. If you say, look, we're not going to tap any taxpayer money, we're independent, we don't need it, then maybe it kind of relieves a little bit of pressure from taxpayers and politicians.
Gives them maybe more free rein to pursue some of their other ambitions. So August 31st, really interesting. That's the date that you're looking at in terms of the next big announcements from this lender. There's been some rebranding as well, the changing around the rebranding. And I know you've been really interested in the Swiss banking unit of Credit Suisse as well. How do you expect those things? Does the time change? The time frame, do you think, change at all for UBS as they absorb this bank?
So I was surprised by speaking to insiders on how quickly they're going, and we kind of really had a glimpse of it when the CEO was replaced by Sergio Armati. So the chairman, I feel, has a feeling of saying, like, we need to go ahead because we need to show investors that we mean business. And the more you let big questions hanging, the worse it is. So I'm expecting big news on the 31st of August, maybe even some kind of decision on the Swiss bank. And if anything, it feels like every 2-3 days we have big internal news, big external news. So they just want to get it quickly, give the markets a template, and then move on to execution.
Okay, really interesting. So we continue to watch any other lines, of course, coming out of UBS on this merger with Credit Suisse. Francine Lacroix, of course, who's been on the granularity of that story for us from day one. Thank you. Coming up, the UK economy delivers its strongest quarterly growth in more than a year. We dig into the details next. This is Bloomberg.
geopolitics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Markets Today. We are 30 minutes into the European trading day. And here are your top stories. UBS shares climb after Switzerland's largest lender ends a $10 billion backstop that helps seal its takeover of Credit Suisse. The pound gets a pop and gilts open lower across the curve as the UK economy grows more than expected in the second quarter. Plus, US core CPI posts the smallest back-to-back gains in more than 2 years, raising prospects of a Fed pause. So some positive headlines for us this morning, but European equities are off about 0.4%. They paired some of the heavier negativity at the start of the session. We, of course, continue to zero in on the UK on the back of that economic data surprise. We'll get the details on that and the analysis in the next couple of minutes. The FTSE 100 trading at 7,581, back below that 7,600 level, off by 0.5%. Over in Germany, the DAX off by 41 points, or 0.2%. The benchmark, as I mentioned, off by currently 0.4%. And across your sectors, interesting to reflect on what is happening in the telecom space and, of course, the banking space and the lift that's coming through from UBS. And that was a surprise for us this morning, taking investors off guard as well. And UBS being rewarded on the back of that decision to cut itself off voluntarily from that $10 billion backstop that it had negotiated with the Swiss government. You can see those two major sectors then in the green. Financial services gaining 0.2%. Utilities, a bit of a safe haven tilt there, up 0.1%. Telecoms as well. Let me just check in on that as a sector. Yes, that is gaining. It's not reflected on the board, but telecoms as a sector up 0.4% on the developments around KKR and its bids for Telecom Italia and the networks part of that business. China had a bit of a terrible day again on the back of concerns around the real estate sector. Country Garden trading as a penny stock, and across the benchmark, the CSI 300 in China ending down by 2.3%. Futures, though, in the US pointed to gains of 0.2% as investors continue to weigh up a softer inflationary picture and whether or not we are now locked in for a pause in September. Let's check in on some of the individual stocks on the move with Joe Easton. Joe, what is jumping out to you at the start?
UBS, Tom, now up around 4.5% following news that they're dropping this backstop with the Swiss government. Now, I've just read the Citi note, and they're highlighting that this will actually mean a reduction in fees that UBS has to pay the Swiss government for this backstop measure. There was a fee coming up in September, and that's one of the reasons that this stock is pushing higher today, because they will save on those costs. Meanwhile, Telecom Italia edging back down. It was up as much as 5% earlier. The Italian government getting involved with that deal by KKR to buy the grid business. That is easing concern that the Italian state could have potentially blocked that deal on national security and even competition grounds as well. So that one is rising too. Now, Bechtel, the German company, now this is an office supply firm. We haven't covered it much before, but they are gaining market share, and this is the third best performer on the index, now the second best performer today. The statement was in German, which didn't make it easy for me, but I did manage to find an analyst note, thankfully, that says they're gaining market share, so that one is moving higher today. Finally, we've got Lotus Bakeries finishing on some Belgian waffles and other cakes. They are reporting €500 million worth of first half sales for the first time ever, and that is pushing that stock higher, leaving them among the top 4 movers today. Tom, now looking at the decliners, we're going to flip over to them. I've brought up 2 rate-sensitive UK stocks just to show what's happening there. Gilt yields coming up. The gilt yield up about 7 basis points this morning, following that hot UK data on GDP, also manufacturing, a couple of other survey numbers. Higher rates, bad for real estate, so British land down around 1.9%, and also negative for house builders, which are, of course, dependent on mortgage rates coming down and helping the home demand pushing back up. But we're not seeing that, and those stocks are declining today. Over in the auto space, we've got Stellantis. This is the owner of Peugeot and a bunch of other brands. They're listed in the US and in Italy. Now, the US auto sector hit yesterday by worries about union negotiations with the Teamsters union potentially pushing up wage costs for all of the US automakers. We saw GM and a couple of other stocks dropping in the US, and Stellantis tracking that move lower, down around 2% today. Finally, just finishing on Siemens, that stock fell as much as 7% yesterday, the biggest decline in 3 years as their factory automation over in China starts to weaken. The deals they have there are starting to slow down. We're seeing that one coming back down again today. Morgan Stanley lowering their price target, and Deutsche Bank saying that earnings estimates will need to come down for the German industrial giant, and that one is down 1% this morning, Tom.
Joe Easton with a beautiful patchwork quilt analysis of what's happening across some of these individual equities, everything from Belgian waffles to the auto sector. Yeah, that wage negotiation, $170,000 a year for UPS drivers. And so whether or not that is going to lead to higher wage demands for auto workers, having that impact across the auto space, really interesting. And Joe giving us the context on UBS and maybe being able to avoid some of these fees being paid to the Swiss government on the back of walking away from that $10 billion backstop. Joe Easton from Equity Team, thank you. Let's get back to the UK economic data now, delivering its strongest quarterly growth, the UK, in more than a year. It is a surprise, and it indicated, again, the resilience in the face of soaring borrowing costs. So to some extent, a bit of a head-scratcher. Lizzie Burden, of course, who covers the UK economy and politics for us. Lizzie, what do you make of this data, and how prolonged this resilience is expected to last for the UK?
Yeah, I mean, the point is that you haven't got a recession yet. And as you say, the UK economy more resilient than expected on both the month and the quarter. If you break it down, you can see that it's partly because there wasn't a bank holiday as you had in the previous month that was for, of course, the King's coronation, but also it was the hottest June in decades. So it's somewhat good news for the Prime Minister, Rishi Sunak, because it's one of his top priorities to grow the economy this year, and he needs an economic revival to be the backdrop for the next general election. But the flip side, as you hint, is, of course, persistent inflation, which means markets and economists reckon you're going to see more hikes from the Bank of England. And that's why you saw the pound initially popping off this decision and then pairing some of those gains.
Yeah, the pound is up and gilts are selling off. Yields up 6 basis points at the front end at 4.96. Your take then, Lizzie, before we cross over to Anna Andrade from Bloomberg Economics, your take on what this means for the BOE and Andrew Bailey.
Well, as I say, it looks like the bank's going to have to keep hiking rates for now. And this is exactly what the chief economist Hugh Pill was warning about last week. But if you look at what markets bets have done off the back of this GDP print, they haven't changed in terms of the hikes, but they have changed in terms of the cuts. They've paired bets on expectations for rate cuts in 2024. The more important numbers, as your former guest, Charlie White-Thompson, was saying earlier, are going to be the inflation and jobs numbers, I reckon.
Yeah, and he has 5.75 in terms of the terminal rate from the BOE. Let's bring in Anna Andrade now from Bloomberg Economics for her analysis and her take as well. Anna Andrade, thank you and good morning. What do you think is the implication then in terms of the Hawks have sat there and the MPC and said, look, we are not done. There is a need to go further. On the politics, of course, the government of Rishi Sunak has said too many people are too downbeat on this UK economy, and this data seems to shore up that argument. But does it make it more challenging for the Bank of England?
Hi, good morning. Yes, I think it definitely makes it more challenging. So today's GDP data actually came as a surprise to us, but would also have come as a surprise to the Bank of England, which had expected the economy to grow by 0.1%, and it came out a little bit stronger than that. Now, what I would say is that, the jury is still a bit out on, on the performance of the economy. And I'm saying this because we've been getting very mixed signals. You had, strong GDP data today, but as Lizzie said, that was partly due to kind of unusual strength due to the hot weather and the rebound from the bank holiday. So I also wouldn't, read too much that into it. But then on the other side, you have unemployment shooting up and the PMI for July already showing that momentum could turn around quickly. So overall, I still, even for the BOE itself, it kind of, it will need to see more data to see how the economy is taking it. But I think the bigger point is that, the economy for now is too resilient, and that will just really give the BOE the cover it needs to kind of continue to hike and to address the risks around inflation persistence.
And Anna, you talk about the data, the importance of looking forward to additional data coming through as the BOE weighs up its next decision. CPI, of course, next week. What is the preview? What's the expectation in terms of the trajectory for the UK's stubborn inflation?
Yeah, so we're going to get a big drop in inflation next week, and that's mostly due to energy. The new Ofgem price cap has kicked in July, and that will just be what's reflected in the data. So we think inflation will fall from 7.9% to 6.8%. Core will remain relatively sticky, so we won't see these kind of good surprises won't be reflected in core. But what we'll see in the data is really just for a long time the UK was thought to have the biggest inflation problem of all the advanced economies, and in part, or like a significant part of it, was just how the energy pricing system works in the UK. And so what we'll see in July and then later again in October is just kind of the inflation converging, going down, and probably, getting closer to the inflation rates that we're seeing in other countries.
Okay, so headline inflation expected to move significantly lower next week, downside, but core to remain relatively sticky. Lizzie, as you project out then for this UK economy in terms of the outlook for growth, the outlook for GDP, and maybe if you can overlay a bit of politics to that as well, what is your expectation? What are you hearing?
Well, let me lean on the Bank of England's forecast here. So they're expecting the economy to get back to its pre-pandemic level in the third quarter of this year. As Anna says, it's still among the last of the major industrial economies to get there, and then the picture from there on out is stagnation.
Also, forgive me for kind of raising an eyebrow at BOE forecasts on the economy. I mean, right? They haven't done a sterling job, have they?
But they were closer than most of the economists on these GDP numbers today. Have to say that. But it's interesting as well that you are seeing some signs of the economy reaching a tipping point here in the UK. So the composite PMI fell sharply in July, and you've got unemployment on its way up. So maybe we're at that turning point.
Okay, Lizzie Burden, of course, who covers UK politics and the UK economy for us on Bloomberg TV, and Anna Andrade from Bloomberg Economics with the analysis on where the BOE goes next on the back of this surprisingly strong data out of the UK. Thank you both. Coming up, fresh from surviving the COVID pandemic, the aviation industry is about to hand passengers a multi-trillion-dollar bill to fight its next existential threat, decarbonisation. This plays into the views of those who suggest that inflation is going to be stickier structurally for us for longer. We discuss that next, the aviation industry and passing on those higher costs around decarbonisation. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
It is 8:45 here in the City of London. This is Markets Today. We are 45 minutes then into your European trading day, and you're seeing losses of 0.5% across the European benchmark. Just two sectors in the green, telecoms and financial services, getting a boost there. Financial services from the upside coming through from UBS. Let's get to what's happening in the aviation sector there. Some really interesting trends. Fresh from surviving the pandemic, the aviation industry is about to hand passengers the $5 trillion bill to fight decarbonisation. With the clock ticking, industry leaders are starting to voice an uncomfortable truth. It is clear, they say, that the costs of weaning air travel off fossil fuels will land on passengers. For more, let's bring in Bloomberg's senior global aviation editor, Anthony Palazzo. Tony, how much is this going to cost the industry then to decarbonise?
Well, first, thanks for having me, Tom. But yeah, as you said, it'll cost about $5 trillion, according to McKinsey, and that's a lot of money. Most of it's going to be spent on producing sustainable aviation fuels and also to produce the renewable energy that will be required for synthetic fuels. Ultimately, a lot of that money is gonna fall to airlines, and then that will be passed on to customers.
I mean, so an obvious question, before we get to the cost to customers, and there is going to be a cost, what is the ability for the aviation industry to actually absorb this $5 trillion cost? We talked about the fact they've come through the pandemic. Some of these airlines got state backing and funding temporarily, at least. They've managed to shore up their balance sheets, many of them, after the shock of the pandemic. Do they have the wherewithal? Do they have the dry powder to be able to afford this?
Right. Well, airlines say they can't do it alone. The current sustainable fuels that are made out of waste oils and fats cost about 2 to 4 times as much as conventional jet fuel does. And then once you get to synthetic fuels, that's going to be 6 to 8 times the cost. So the airlines they're lobbying governments for subsidies. They've had some success with that in the U.S. They're also investing in biofuels so that they can increase the supplies and bring down the costs. But ultimately, a lot of this is going to be borne by passengers.
So, yeah, what is the cost then for you and I, for the passenger?
Well, that's a good question. So there's some estimates out there, and of course, these are early days, so we don't know exactly. But there's some estimates out there for example, for a short trip, say Zurich to Amsterdam round trip. In 2050, the extra added cost would be somewhere between $10 and $25. And then if you go on a longer trip, like say New York to London or Paris, you're talking about $150 for a round trip in added costs on top of inflation and everything else.
Okay, so that's that additional cost, maybe for a long haul flight of about $150 US dollars.
Yeah,
some would make the
that's
argument,
right.
obviously, that's a relatively small price to pay for flying a green flight, or at least a relatively suddenly a flight that has a reduced carbon footprint. What is the timing of this? When does this? You talk about 2050. Yeah. Is that this is a long time frame? Where is the aviation industry in terms of addressing this and moving towards this?
Well, right now you're starting to see the cost even coming down to customers. So, for example, airlines like United are asking customers to pay a voluntary surcharge. Anywhere from $3 a flight on up. But Air France KLM here in Europe, there are mandates that are already taking effect, and Air France KLM is charging anywhere from €2 to 24 euros for flights out of Amsterdam or from Paris.
But where are we on the technology? I mean, how advanced is this technology? How realistic is it? When are we going to start to see planes fueled by biofuels?
Well, the technology is there. This is all doable in terms of, just purely the science. The big thing is the cost and the organization around it. Getting everybody to rally around sustainable aviation fuels. That in and of itself was a big hurdle.
Does the Inflation Reduction Act in the US, does that feed into that? Does it give airlines in the US a head start?
Well, the airlines say yes. Now, of course, it's good for them because having a subsidy of anywhere from $1.50 to $1.75 per gallon of fuel really helps them. Takes the sting out of the cost. So they say yes. There's a whole nother argument that says that the mandates that Europe is putting in place are really what's going to be required in order to make this all really happen.
Okay, so looking at those European mandates, really, really interesting deep dive. That's the big take today, of course, authored by Tony and team. Anthony Palazzo, of course, who is Bloomberg's senior global aviation editor, on the transition to green fuels in the aviation industry and the costs for that industry, and of course, the traveller and consumer. Thank you for the analysis. Coming up, we're going to discuss the state of the US economy and the Fed's hiking cycle. After that, relatively tame inflation data. Valerie Teitel is going to break down the market implications and the steps next for the Fed. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Markets Today, 53 minutes into the European trading day. You're seeing stocks down across the benchmark, down 0.5%. Some caution coming through in terms of the commentary from Fed officials like Mary Daly on the need to do more, despite the softer inflation print and further pessimism coming through from China and the real estate market. One area, though, of optimism is UBS lifting the banking sector. UBS is gaining. Currently, that stock up 3.8% on its decision to voluntarily walk away from a $10 billion backstop and lifeline from the Swiss government. Backstop more than a lifeline. And that's seen as positive in terms of what it says about UBS absorbing assets from Credit Suisse and maybe less troublesome and less of a challenge in terms of those assets. Let's get back to the macro picture in the US then, the CPI print and the core inflation specifically. The Fed widely, as a result of that, expected to pause its rate hikes next month following the release then of what has been described as tame US inflation, which showed that core CPI rose 0.2% in July. It marked the smallest back-to-back gains in more than 2 years. Valerie Teitel's been crunching the numbers for us and putting this all into context. Valerie, does it mean that basically we're locked in for September as a pause? What is your expectation in terms of disinflationary picture and where the Fed goes?
Well, we still have one more CPI print to go, but from what the market says, it says that a September pause is very much in the cards at the moment. Only 2 basis points priced for that September meeting. Now, it is on September 30th, so we still have a while to go before that, including Jackson Hole. But the market yesterday really did a kind of disinflation dance at the very beginning. You know, it was very risk sentiment positive. Equity futures up over 1%. Saw a really decent bond rally, but then it all reversed, Tom. And a lot of questions on why that was. But the kicker for that was that week 30-year bond auction that we got at 6 p.m. London time yesterday. That really was the kicker to drag yields higher and was maybe a signal that the market wanted to position back into these steepeners. Remember that steepening trade last week really did very well around these debt concerns, around these auction concerns, and possibly a week 30-year auction let the market confirm that that kind of weakness might persist and wanted to reload into that kind of positioning.
Just briefly then, Valerie, the risks ahead.
We've got Jackson Hole. Maybe Powell won't be doing the disinflation dance just yet, but perhaps he might give some consent to that inflation print yesterday. We'll see if he does. We know we heard from Mary Daly yesterday, and she very much did not. She said that the Fed still had some more work to do.
Okay, I think you need to coin this, the disinflation dance. Valerie Teitel, thank you very much indeed on the market reaction to what is happening. Yields are actually coming in a little bit in the session today, but absolutely, of course, you saw that jump in yields and sell-off across Treasuries yesterday, and we focused in on that 30-year auction. Checking in on gilts here in the UK after that stronger than expected data coming through for the UK economy, and gilt yields are up 4 basis points at the front end on the 2-year. The 10-year up 8 basis points, and more pronounced at the back end. The 10-year currently at 4.43. Inflation out of the UK next week. Stay with us. You get more insights from the team, of course, on the UK website. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And then Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, I'm a man of my word, I got a tattoo.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. UBS scraps the Swiss government backstops that helps seal its Credit Suisse takeover, including a 9 billion franc loss protection deal. U.S. core CPI posts the smallest back-to-back gains in more than 2 years, raising prospects of a Fed pause. Plus, the U.K. economy actually surprises with the strongest quarterly growth in more than a year. So let's take a look at the European markets map to actually have a look at some of the assets that we're looking out for. You can see, for the moment, we're seeing a bit of pressure with the FTSE down 0.7%, similar losses across the board with the CAC 40 and the FTSE MIB. Now, it was a big week. It was not only a big week for currencies, it was certainly a big week for treasuries. If you look at sterling, let's probably start there because we had GDP better than expected here in the UK. If you look at what pound's been doing, it's one of the ones that we've been watching for the most. So let's get sterling up. There you go. Pound relatively strong so far. It's off a recent peak, and of course this goes into the narrative of we could see some kind of pause, which the Bank of England was really at pains in trying to explain in the press conference. They didn't say they would pause, but they said what we need to make sure is that these interest rates could actually stay higher for longer. Then the 10-year ending a week, a bit of on a back foot, 3 big Treasury auctions and a CPI print in the week. The auctions went fine. CPI was also okay. Yesterday's report on U.S. budget balance in July actually showed U.S. deficit at $220 billion versus an estimated $135. The Treasury has had to increase auction size increases. Then a couple of corporate stories. We have Country Garden. This was one of our main stories today. 31% lower on the week. There's been a lot of talk about what this means for bondholders going forward. This is after also Moody's came in and downgraded a slew of banks, and that was one of the exposures to the commercial real estate, which are seeing cracks continuing in the space in 2 very different markets. So one's WeWork, down 17% on the week in Country Garden. And then finally, there's one story that we need to also watch out for, and that's Telecom Italia. We understand that there's a blueprint for a deal. KKR would take most of the Telecom Italia network, and then Italy, the Italian government, would have a 20% stake in that as well. For the moment, Telecom Italia gaining 1.7%. We look at oil. It's been a big story this week also because of LNG strikes, possible LNG strikes in Australia. Global oil demand hitting a record. Prices may climb. That's according to the latest IEA. You can see for the moment, oil, New York oil, 82.92. Well, American oil. I wouldn't say New York oil. Now, UBS has ended an agreement with the Swiss government to cover its losses it could incur from the rescue of Credit Suisse. It is a sign that the stricken lender's assets might actually be less troublesome than initially thought. For more on all of this, we're joined by Bloomberg's Jan-Patrick Barnett. JP, thank you so much for joining us. Love the screens behind you. You're like a space shuttle looking at the UBS share price minute by minute. Is this good news just because they removed themselves a little bit from the eyes of the politicians and the Swiss government?
Yeah, it's absolutely good news, and it's very surprising to me. And it's one of those headlines where you almost spill your coffee over breakfast, because usually you would think that the bank, especially in this situation, is very careful of giving back such a guarantee and be a little bit more like, let's wait and see. But it looks like that UBS did a very thorough and very fast job in assessing those assets on the Credit Suisse balance sheet. And I guess they had two choices here: either protect the balance sheet or protect the UBS brand. And it seems like that they came to the conclusion now that the balance sheet is totally fine and that those assets are going to be all right in the future. So they opted for going to protect the brand or restore some of the criticism, because there was a lot of public outcry that once again you need billions of taxpayer money potentially to save a troubled bank 15 years after the financial crisis. So it's a very smart decision for them to say, like, okay, looks like we don't need it, so we give it back. That helps our brand, and of course sends a very strong message to shareholders to say, like, look, all your worries about this about this merger that we are now earning the troubles of Credit Suisse, so to speak, is not going to happen, at least for the asset side.
So, JP, I mean, the timing I thought was quite interesting, because on the 31st of August, we're expecting news. There's not only earnings, but really an update on the merger. Could we see something big on the 31st of August? Or is this also just remove themselves ahead of the Swiss election? Like, for me, it means, yes, they haven't found anything too ugly in the Credit Suisse books. They had until mid-June to look through that. But could it be the sense of something bigger coming?
Maybe. I'm not 100% sure, but I think like what UBS is trying to do here, and I said that from the beginning of the merger, what's needed now is like a constant stream of positive news to get this merger going and to keep everybody on board, especially the shareholders and the government. And we were seeing that already. They gave us a rough timeline very early. They settled some of the legacy legal issues of Credit Suisse. Now we have the guarantees being put back to the government, and I would be pretty sure that we get something more on the earnings day, where they will tell us, okay, look, this is where we stand now, and that's how we're going to progress with the merger. There's still the big topic of how they align all the customers, all the programs, all the IT software, all the people in the two banks. That's still a big issue, and that will take time. But I think UBS is doing the absolute right thing here. Is like showing we are going ahead, we are making progress, good progress with the merger, step by step. It's not going to be a super fast progress, but they keep us updated timely with positive news. And as long as they keep doing this and show the results, then I think like shareholders will rebuild their trust in that this merger is actually beneficial.
Thank you so much. JP Barnett there with the very latest, and I think UBS is gaining some 4%. Now, U.S. core CPI posted the smallest back-to-back gains in more than 2 years yesterday. Joining us now to talk about what this means for the Fed and, of course, what it means for the U.S. economy, Bloomberg's Christina Kina and BNP Paribas Asset Management Global Head of Multi-Asset, Maya Bhandari. So thank you both for joining us. Maya, I'm so excited to have you on a big day. I mean, it's been a big week. We had auctions, we had CPI. What does this give us in terms of glimpse into the way forward for the Fed?
Well, I mean, I think yesterday's inflation number was certainly welcome news for the Fed. I think, I guess, two pieces perhaps that I draw attention to. One was when we look at the headline number, we saw quite a significant reduction in food away from home, which is one of the more persistent sources of inflation. So that's back down to its pre-pandemic trend. And then on the core side, which was arguably a bit stickier, over half of it was, a lot of it was shelter, which was up 50%, and we expect that to come down. So I think broadly the inflation news was good news for central banks. I think we believe at BNP Paribas Asset Management that we are at, if not very close, to peak rates. The question, of course, is how fast they can come down, and there we are less sure. And I think the comments you made
a moment ago on gasoline prices and oil prices are quite prescient, of course, because there's a high degree of sensitivity to that in the U.S.
Yeah, and Christina, thank you for all of the viewers that actually write in. We have a very loyal viewer who I think is based in the U.S. So not only is it 4 a.m., but also he's not on holiday in August. And he's writing in saying, look, the concern with the markets right now is that there's no real catalyst going forward. Where will the catalyst be?
Well, Francine, yeah, that is the big question, isn't it? I think what we've kind of been experiencing, especially now, I mean, it's the summer markets, that's one aspect of it, of course, but also this idea that central banks the world over are now telling us that they're data dependent. And so I think that's the trouble with markets, is that they really want to latch onto something to be able to kind of price things off of. But at the moment, it's kind of difficult, because we've heard from the Fed, the Bank of England, even the ECB, all saying that they're waiting for the data, and that's forcing markets to do the same thing. Now, of course, we know what the biggies are, right? We just had the jobs data out of the U.S., and of course, inflation kind of giving us some encouraging news on the inflation front, but also mixed signals, right? Because I think, as Maya was pointing out, like there were some encouraging signs in terms of cooling inflation. Core, though, looking a little bit sticky, and super core, I would note, which is what Jay Powell in particular is looking at. That has accelerated more than expected, and so there's always this fear that, oh, maybe the Fed's going to have to rethink this idea of that peak rate coming sooner or later. And that's something I think we still have rate cut bets priced in the U.S., and I think that's something that markets are still kind of trying to brace for, even kind of as an outlier scenario.
Yeah, so what does it mean for,
And I think one of the most striking things, Francine, at the moment is the disparate pricing between bonds and equities. When we look at bond premia and compare those with equity premia, you've got the biggest gap in 15 years. In other words, bonds are looking more attractive than they have for a good while, really since the GFC. And so what we've been doing with this is really leaning into long duration positions, very cognizant of our conversation just now around inflation. We've been doing that recently more through TIPS, so long dated inflation protected bonds in the US, where I think yields over 2% are attractive.
And do you look at regionally? Is it like a regional by regional bet, actually?
Yes, at the moment, I mean, we have we feel perhaps the greatest conviction in the US. So we have long dated TIPS. We also have some nominal exposure, but actually quite recently we've also unhedged our European investment grade long position. In other words, taking the spread risk along with the duration risk, because of course in Europe the data is a fair bit softer than it is in the US, and we are a little bit more concerned around the growth picture there.
And Christina, I know you've done quite a lot of work on valuations, focus on the UK, but also in Europe in general.
Yeah, absolutely, Francine. I mean, the refrain in Europe and the UK, right? It's cheap, and therefore it must be a good buy. But I do question sometimes the argument around cheapness, just because it's probably cheap for a reason. I mean, that's certainly the argument in the UK. But you have actually seen kind of a bit of resilience, should we say, in the UK equity market. Of course, we hit kind of some of those highs that we saw earlier in the summer. We pulled back a little bit from there. But of course, there is this argument to be made that perhaps all the bad news is potentially already in a price. I mean, one thing that we are noticing is that we just keep kind of getting surprised to the upside, perhaps when it comes to the economy in the UK, and also the resilience of consumers in particular. And so that certainly bodes well for some of the more consumer-focused stocks, not just on the FTSE 100, but also on the domestically focused FTSE 250. And so, yeah, maybe perhaps there's a little bit of credence to the idea that they are cheap enough that it is potentially a good buy at this stage, especially if there's potential for some of that bad news to fade away slowly.
Christine, thank you so much. Christina Aquino, there were the very latest on the markets. Maya, thank you as well. But Maya Mandari from BNP Paribas Asset Management stays with us. We'll talk a little bit more in depth about the UK and the better than expected economic data. That's next, and this is Bloomberg. What do you like most about your job?
I think the people, I mean, ultimately we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Welcome back to The Pulse, everyone. The pound gained after the UK second quarter GDP came in better than estimated, thanks to unexpected growth in manufacturing. You can see sterling 127.12 right now. Now, both Bloomberg Economics and Bloomberg Intelligence say that the economy is eking out growth amid rising rates, strengthening their view that the BOE will need to generate more weakness in the economy to tame inflation. Well, joining us now to discuss all of this is Bloomberg's Brendan Scott, and still with us, BNP Paribas Asset Management's Global Head of Multi-Asset, Maya Bandar. So Maya, thank you so much for sticking around. Brendan, you're also our managing editor for UK Economics and Governments, and I feel like it's the most fun and difficult job in the world because we're trying to figure out the BOE has a tougher time than others. They've probably, you could argue, were late to the game in terms of hiking. So what do they do with this GDP number?
I think it's just going to reinforce their view that they're not done hiking yet. The markets are still pricing in a hike again of a quarter point in September. This is just going to make that seem more likely. Of course, this is backward-looking data. We're talking about the second quarter of this year, ending in June. It's already behind us. We've already seen output in PMIs slowing down. We've seen unemployment ticking up. So it seems like we could be on the cusp here. We could be seeing the end of a pretty good first half. What happens in the second half of the year still remains to be seen.
I feel like if you're a central bank nowadays, but especially Bank of England, it's damn if you do and damn if you don't. Yeah. I mean, is there a sub-data that they should be looking at to try and calibrate it so it's just right?
Well, I mean, I think the Bank of England faces perhaps the most intense version of that pinch point between growth and inflation. I mean, there are many differences here with the UK, most notably in the mortgage market and the transmission of higher rates to households. And so I think the bank does need to be quite careful. Again, I think the challenge is a bit higher for the Bank of England than it is for other central banks. Inflation is still a factor of 4 above the target. But indeed, I mean, we don't think that the Bank of England should or indeed will just continue to power ahead with rate hikes off the back of certainly today's data, which, as you reflected, is very much backward looking.
Yeah, it's backward looking, but also the concern, right, is that we're starting to see a little bit of the impact of how much they've raised rates. Mm-hmm. Is it taking longer than expected to actually, filter through the economy? Is this the main concern, which is why the BOE is really at pains and saying we could stay at these levels for much longer to just see how it pans out? Yeah,
I mean, the Bank of England Governor Andrew Bailey was quite clear in his last public appearance when they were announcing that last quarter point hike that rates could stay higher for longer, that it's going to be a long process. Don't get excited about cuts. Even if they can start talking about a pause sometime in the next few months, that the discussion of a cut is far down the road.
So what do you do with UK assets? This is like the million-dollar question. I mean, we had a couple of government ministers also saying, you know, to grow, we're going to get investments. Is it attractive at the moment?
Well, I mean, I think when you talk about UK assets, you need to be careful which UK assets you're talking about. So certainly things like gilts, for example, are things that are very much focused on the UK economy. It's something we like. We like gilts relative to bunds, for example. But of course, when you get to UK equities, they have very little to do with the UK economy, right? 75% of your revenues on the FTSE 100 come from overseas. And actually on that overseas picture, we're a little bit more cautious. You know, this sort of Goldilocks-like narrative that seems to be very much the consensus-based case looks a bit complacent to us, and we'd see sort of downside risk to growth, certainly that narrative in most places, including the UK.
So we'll see, right, if they've kind of managed this big experiment. Yeah. What happens now? I mean, so we're looking at inflation, and I think the next time the Bank of England meets, we'll have, you know, 2 inflation prints because it's September 21st.
Yeah, and not just the inflation prints, we'll also have wage data, which could give the bank a clear signal on what's happening on the services side. They're very concerned about rising wages and those coming down in order to keep the pressure down on certain sectors that are driving up the CPI.
Maya, does the ECB have a easier job, and what does that mean for your, you know, appetite for European or Central European stocks?
Yeah, I mean, I think Europe in a way has a similar problem in that, you know, you've got pretty sticky wages, to your point, and that I think is something that the ECB is quite mindful of. But when it comes to equities, actually, Europe is the area where we are most cautious at the moment. I mean, you know, European earnings are expected never came off and are expected to steadily rise 2.5% this year, low single digits next year and the year after. And of course, we know that when you have a weaker macro outcome, as we expect, earnings actually tend to fall by 10, 15, 20%. And so Europe is an area where we are particularly cautious because we see a real disconnect between earnings and the macro.
Maya, thank you so much. Maya Bandari there and Brendan Scott. Maya's from BNP Paribas Asset Management, where she's global head of multi-assets. And of course, Brendan Scott is our managing editor for UK government and politics. Coming up, crumbling to a penny stock. Country Garden has plunged about 70% from its January peak as debt concerns grow. We'll have full details on that story next, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become
the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Chinese property developer Country Garden has become a Hong Kong penny stock amid increasing scrutiny of its operations and mounting liquidity concerns. Now, Country Garden's fall from grace really underscores how a persistent slump in property prices is weighing in on some of China's strongest private builders. Now, for more, we're joined by Rebecca Chung-Wilkins, our Asia government and politics correspondent. So, Rebecca, how quickly has that happened? And we had a lot of concerns about this infiltrating or infecting the sector elsewhere. Because it's a penny stock, is that concern now removed?
Well, yes and no. I mean, I think more broadly, the bigger question of whether we actually see a default by Country Garden is still up in the air. They've got about 3-4 more weeks to figure out if they can pay this coupon. It's about 23 million across 2 different bonds. But if you look at how the firm is being priced, both in the bonds and with that penny stock too, you can see people are not just pricing in a default, but also very low chances of any kind of recovery, something around 7 cents, 6 cents on the dollar here on their dollar notes.
And Rebecca, I mean, it's really incredible. This is our big number of the day, and it's $47 billion. $47 billion. This is the market cap that Country Garden has lost since its peak in 2018. What does that mean for the government and their future support of the sector?
Yeah, it is extraordinary. When I first started covering Country Garden about 3 years ago, it was China's largest developer by sales. Now, the interesting thing, although it's a loss of its market cap, it's still a very big player in China, about number 6. And it's got a lot of pre-sold units that it will need to deliver. So in China, people tend to buy their properties before they're built, before they're actually given. When we saw Evergrande default, there was this quite a sort of pressing issue of mortgage boycotts. Essentially, Evergrande's operations in some parts ground to a halt, and people that had bought homes didn't get them delivered. Now, this social unrest issue is going to be prevalent and top of mind for Beijing. About 80 million square feet in unfinished homes that it needs to complete. So it is a bit of a challenge, and a lot of this is also spread over quite a large area in China, also in these lower tier cities where we're not expecting that easing of policy by Beijing to help boost the property market. We're not really expecting those policies to touch those lower tier cities. So it is really a challenge for policymakers here.
Rebecca, thank you so much, as always, for all of your insight and wisdom. Rebecca Chung-Wilkins in Hong Kong. Coming up, UBS says it's voluntarily ending the 9 billion Swiss franc government loss protection. We'll have more on why the Swiss lender has done this and really why now. This is Bloomberg. Yeah, it's good. Good job. Great. Hey, Marion.
Hey, Francine. How are you?
How are you, my dear? I'm pretty good.
I'm doing well. You know, I miss these early morning, surprise.
There you go. On a Friday in August. I was like, what?
Francine, in Europe, August is supposed to be slow, but ever since I've been on this beat, like every August has been crazy.
That's so funny. I mean, I thought you were off actually, because I did like a quick, because they called me when I was coming in. And so I did a quick on my back, and I thought you had the red.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
UBS scraps the Swiss government backstops that helped seal its Credit Suisse takeover, including a 9 billion franc loss protection deal. U.S. core CPI posts the smallest back-to-back gains in more than 2 years, raising prospects of a Fed pause, plus the UK economy surprises with the strongest quarterly growth in more than a year. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, UBS has ended an agreement with the Swiss government to cover losses it could incur from the rescue of Credit Suisse. It's a sign that the stricken lender's assets might actually be less troublesome than initially thought. Now, for more, we're joined by Bloomberg's Marion Halftermeyer in Zurich, who's been on top of the story from the very beginning. Marion, you're really the person that I wanted to call this morning at 5 a.m. Like, why did UBS do this?
This is really a show of strength for them in this deal, right? They are on track, and they're saying, you know what, actually, we did the due diligence now, because in March, when there was this rescue deal, they didn't have the time to look at everything going on in Credit Suisse. But now they said, you know, we've looked at it, we think we can handle it, and we don't need your government support. Now, this also helps them move forward without a lot of the public discussion and the court of public opinion on, are we going to have to support this transaction in the same way that the Swiss taxpayers were asked to support state bailouts back in this financial crisis in 2008. On the other hand, it also allows them to move forward in the vein that this is a purely commercial transaction now. They don't have to report back to the government on what they're going to be making losses on anymore because the government's not paying for it anymore.
And so what does this actually mean for the integration of Credit Suisse? Could this give them a lot more runway of deciding on, you know, some of the more contentious issues with the Swiss Universal Bank, or is it just putting that distance in an election year in Switzerland?
It definitely helps put that distance. In terms of the integration, they sort of say it's not necessarily related to the Swiss unit decision. So, of course, we're still waiting whether or not they're keeping that Credit Suisse domestic retail banking operations or whether there's a plan to IPO it or carve it out. That decision we'll get more information on at the end of the month and over the course of the next quarter. But it is really a good sign that they're moving fast, they're on track, and that they have a plan. So hopefully we'll get more details on that coming soon.
So, Marion, what role will the Swiss government and the finance ministry play going forward?
So UBS still has some leniency in terms of capital ratios and different regulatory metrics. So they'll still have to be surveying what UBS is doing in the sense that they're the regulator, and this is obviously a highly watched deal. But in terms of the government actually being involved in deciding on how things are wound down from parts of Credit Suisse, there will be less involvement, and UBS can really move forward and not necessarily be held back by what might be some political decisions or some political pressure.
Marion, very quickly, I mean, why did they do it now and not August 31st? I know we're all, gearing up for the earnings results on August 31st. We could potentially see a lot more news out there on the merger and other things. Was it smart to do it ahead of that?
I think they're taking the approach that the better they can communicate information, the better it is for analysts, investors, the public to really assess whether this is going to be a good thing or not. And that is the onus. That is the chairman and the CEO. They will have to prove that they made the right decision. And so the more they can come out with information as fast as possible, and that information that shows strength, the better for them and the better for the share price. You'll see the shares have gone up a lot today.
Yeah, they're up some 4%. Marion, as always, thank you so much. Marion Halftermeyer there in Zurich. Now, fund managers relying on ESG scores to weigh portfolios might be undermining their own efforts to cut carbon emissions. At least that's according to a recent study from investment service venture Scientific Beta. Now, researchers found that 92% of the reduction that investors can achieve by solely weighting stocks to minimize carbon intensity is lost when incorporating broader ESG scores. The findings add to the growing scrutiny of the ESG ratings industry. Well, joining us now is Yuko Takano, Senior Investment Manager at Pictet Asset Management. Yuko, as always, thank you for joining us. It just feels like the ESG debate is really more raging than before. Is it a good thing? Is it a bad thing? People are weighing, especially from the U.S. investors. You have cared about this for a long time. Like, what does it mean for an investor being now ESG invested?
I think that the main issue, and it has been for a while in this industry, is that, as a pretty quick solution to creating or managing ESG funds, investors tended to really rely on these ESG scoring methods, which is, first of all, it's backward looking. And so as investors, you always need to be looking into the future and how a company is transitioning, like where are the emissions going, rather than looking at the present. And I think what's really distorted the market is, the existence of these scoring, which is, it's necessary. It's like a rating agency, but to kind of solely rely on that and to make your investment decisions or allocation decisions based on that, I think is a huge issue. And I think that's why all of these issues have been starting to come up.
So how do you allocate? What kind of research do you do to make sure that, there's no to little greenwashing, and that investors can be confident in what the new generation, I guess, of ESG products bring?
So I think the number one solution to all of this, especially as active equity investors, and I think this is really a point where we can make a difference as active equity investors, is to do fundamental analysis. Like, in our case, our portfolio is extremely concentrated. It's a 40-stock portfolio. We know every single one of our companies. We can do deep research into them. And so I think for those investors who are willing to put in that effort and to manage their funds in that type of way, this could be very good, because ESG is here to stay. A lot of these factors are important in investing and making high returns. And so we do look at the scoring. We do see that as a type of data point, but we don't rely on that. And I think that's really important going forward.
Given also that, I guess through the political lens and people looking at ESG, do you think the trend will accelerate? You say ESG is here to stay, and there's no doubt about it, but I wonder whether it's going to take a back step, or do you see the fundamentals in the companies that you cover and study deeply actually being accelerated?
I think it definitely ebbs and flows. And unfortunately, some investors do tend to decide their stance on ESG based on their political beliefs. But in the long run, you just spoke about the U.S. market, for example. When we look at the U.S., our U.S. clients, they're a broad range of clients. And, some really think that this is the way forward, others not so much. That's perfectly fine. It's kind of very similar to making a decision between, value and growth, or fixed income and equities. It's an allocation decision for them. So for us, it's, what really matters is to do the best job that we can possible. But, if you look on the corporate side, ESG is definitely way, way higher up on the corporate agenda than maybe even compared to 2 years ago. So I do think that this is here to stay.
And if there's one corporate in a sector, does does it kind of incentivize the rest of the sector to go in? Are you like adding, if you have a portfolio, I guess, of 40 companies, do you add and remove them, or is it just analyzing those? I mean, how much do they fluctuate?
So, I mean, we're long-term investors, so we do have a pretty long holding period, 3 to 5 years, sometimes 10 is what we aim for, you know, if you find that really good company. But obviously, on the corporate side, what we do is engagement. So what we do when we see a company that is, you know, there could be a company that's top-notch in engagement and top-notch in ESG, and then there could be laggards. And we really think that laggards are very interesting because they're on the path to transition. And so what we do with them is we approach them and we say, look, this is what the best in class is doing. Why don't you do the same? Because it will change the perception of your company. And I think that's one way to approach it.
Is there an industry, actually, that you think, you know, maybe hasn't been getting a lot of love, you know, from ESG investors that should, that is actually making meaningful progress?
Definitely in the energy sector, there are companies that are doing really interesting things, not necessarily in oil and gas per se, but you know, we've looked at some companies in oil services that have really interesting compression technology that can be applied to other renewables or other sources of energy, not just oil and gas. So we think that sector is really, really interesting.
In general, these corporates, of course, are also, I guess, interest rate dependent. I mean, how much do you look at what the Fed and the you know, inflation trajectory looks like?
Yeah, I mean, we do look at it, especially in terms of input costs. I mean, that's a really big factor when we make investment decisions. And so what we look at is, you know, pricing power of these companies, how unique their products are, how much pricing power do they have over their clients, and I think that's the most important thing. I think the Fed is very prudent in terms of, you know, trying to manage the inflation, but, you know, obviously the Fed is not working for the markets. They're working for U.S. citizens, so, you know, we can't really control that.
We cannot. Yuko, thank you so much, as always, for joining us. Yuko Takano, there, Senior Investment Manager at Pictet Asset Management. Now, we're just getting some breaking news out of China. China's actually posting its lowest new yuan loans since July of 2009. Now, we'll dig into deeper into why these are some of the underlying reasons. We have this week followed very closely about potential, if not default, certainly creditors not being paid coupons on time in the real estate market. This feels like something a little bit different. China just coming out, for example, the aggregate financing, that's half of the estimate, and actually the new yuan loans, that's also half of what was estimated. So does that mean that they're trying to maybe take a little bit of that bubble out of the economy? We'll look into that, and of course, we'll see how the markets open come Monday. Coming up, KKR signs a preliminary agreement with Italy's economy minister or ministry that could give the government as much as 20% in Telecom Italia. So we'll bring you all the details next, and this is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
And the markets are on the move.
The focus
focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis, we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
In his first international media interview since becoming Taiwan's vice president, Lai Ching-te speaks to Bloomberg exclusively about his presidential run in China.
Taiwan security is a global issue, and the peace in the Indo-Pacific region benefit all the country.
What kind of leader would he be? What are his plans for Taiwan? And what would they mean for the world? Tune in all day August 15th, only on Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is a pulse. I'm Francine Lacqua here in London. Now, U.S. private equity firm KKR has signed a preliminary agreement with Italy's finance ministry that could give the Italian government as much as 20% stake in Telecom Italia. Now, this comes as the phone network all looks set to sell assets to reduce its debt pile. Now, the announcement marks the second major move by the Italian Prime Minister, Giorgia Meloni, after the surprise plan for a windfall tax on banks. Now, for more on all of this, we're joined by Bloomberg's Alessandra Migliaccio, who's been covering this. Alessandra, thank you for joining us. Happy August. Tell us more about this deal and how significant is it for the Italian government?
Well, it's pretty significant. It's interesting that there aren't a lot of details about the deal. I mean, the press release says that the terms of the offer foresee a decisive role for the government in defining strategic choices, and I quote. So, I mean, basically, look, it's about the Italian government having a say in everything that happens in corporate Italy. So it's very interesting for investors, I think, and for all of us to realize, I mean, not that we had that many doubts given the nature of this type of government, but she wants to be involved in every step of the process in future in companies like Telecom Italia and beyond.
So, I mean, why? Is this to have control? Is it a populist move to show the people that they're not letting go? Is it anti-corporate? Like, what are the underlying reasons?
Yeah, there are a lot of reasons. I mean, one of the things is the history of the party. I mean, she does come from a former fascist party that has a history of not trusting capitalism, essentially. I mean, she believes that the state needs to be involved in every part of the process, in every kind of decision, and it needs to, it's a form, you know, in France, it's called dirigisme. You can call it interventionism. She basically also, you know, she got lucky when she first arrived, she was able to nominate all the new state company heads. She did that. And now she's moving in on all the big corporate decisions. Anything she deems strategic, and there are a lot of things she deems strategic, from aerospace to communications to networks to grids to energy. She says, okay, you know, do whatever you like, make money. I'm not going to redistribute it. She's not necessarily a communist. She's dirigiste. She wants the government to have a say, to decide, to say if it's okay or not. And she does this by taking stakes, by having golden powers over certain things. I mean, she recently, just this week, passed a norm saying technology transfers, even within your own company, need to be approved by the state if they're outside of the EU, just to give an example. And there are tons of examples. So it's part of her DNA. She doesn't trust the process, the capitalist process.
So, Alessandra, I mean, after that, you know, frankly, the shock of the windfall tax on banks that no one was expecting, which then they walked out, are there other big portfolios or industries that could be touched by the government in the next 6 months? Like, what's next?
Right. I mean, that's obviously the question. I think any state company, because, of course, you know, Italy, we have to clarify one thing. Italy has always had state companies, and the biggest and most important ones are actually state-controlled. But it had a little bit more of a laissez-faire attitude. The difference now is she wants to micromanage. I mean, I'll give you an example. Terna, the grid operator, very recently, she summoned the CEO to discuss the departure of some middle managers. That's how microscopic the control is. She's a micromanager. In the future, we might see this in the fields are essentially that she's identified her energy, artificial intelligence, semiconductors, you know, anything that grids, all kinds of grids, telecommunications. So anything that she thinks could be strategic for the country, but that's pretty broad, she will be involved in.
Okay, so interesting. Thank you so much, Alessandra Migliaccio, there with the very latest, of course, on Italy and this move by the government for Telecom Italia and KKR. Now, some bad news. Hold on tight, fasten your seatbelt. Bad news for pizza lovers. The cost of making a classic pizza margherita at home rose at more than twice the pace of overall inflation in Italy last month. And that's because of olive oil. Olive oil prices have soared by close to 1/3. Now, the essential cooking oil found in most, if not all, Italian kitchens saw the biggest increase among the staples tracked by Bloomberg's Pizza Index. Now, the overall cost of making a pizza in July rose 13.5% from a year earlier, compared with a national inflation rate of just under 6%. A devastating drought in Spain, the world's biggest producer of olive oil, has actually caused a spike in prices at a time of dry conditions across the Mediterranean. Now, we'll have plenty more on China. We had breaking news in the last couple of minutes. China actually posting its lowest new yuan loans since July 2009. What that means is that we could see a significant slowing economy as consumers, but businesses take out less loans than expected. We'll have a full roundup of what it means for the China economy. This is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
I like real businesses, real clients, real revenues, real profits.
James Gorman is the longtime CEO of Morgan Stanley. In May 2023, the Australia-born Gorman said he plans to retire sometime in the next year. Morgan Stanley shareholders were disappointed. The stock fell on the news. So the question now is whether Morgan Stanley's next leader can build on Gorman's turnaround success.
The three internal candidates are co-president Ted Pick. He's the head of institutional securities, co-president Andy Saperstein. He's the head of wealth management, and Dan Simkowitz, the head of investment management.
Whoever the board chooses, analysts say the quicker the handoff, the better, to prevent political infighting that would distract from longer-term goals. The next CEO skill set must include the ability to deal with liquidity that's likely to be stressed and money that will cost more. And U.S. regulators are monitoring big companies getting bigger. Risk management will also matter, especially for globally systemic important banks like Morgan Stanley.
Remember, it was also James Gorman's personality. He had the charisma to bring two sides of a bank with very different cultures, investment management and trading all together. The next person will have to do the same while setting the bar even higher for Morgan Stanley.
Well, Sonali Basak and Scarlett Fu with a look at what might be next for Morgan Stanley once James Gorman actually departs as chief executive officer. Now, China's latest monthly new yuan loans have dropped to the lowest since 2009. For team analysis, let's get straight to Bloomberg's Valerie Teitel and Tom McKenzie. Thank you both. I mean, this is a huge deal. Tom, thank you so much for flagging it, because that headline crossed the Bloomberg terminal. I mean, how bad does this look for the Chinese economy?
Well, this really jumped out to me because as Hao Hong, who's a really close watcher of the Chinese economy, formerly of BOCOM, and an analyst there, said to me, look, even if you get that fiscal impulse from regulators, from the PBOC, from the finance ministry that so many people are calling out for, there isn't necessarily the demand to take it up. And that's what you're seeing from these new yuan loans, coming in at less than half the estimates at those 2009 loans. Businesses, corporations and households are seeing so much uncertainty. There is so much angst. They are not willing to take on this additional debt. They don't see a clear path to further growth, and that is the concern for policymakers. Even if they come through with the big guns on fiscal stimulus, who's going to take it up?
Yeah, and this just adds to a raft of negative data that we've had on China.
A whole lot of negative data on China and all these grumblings about Country Garden, what's going on in the property development market there. But I think the market really is going to jump to some big conclusion about this being a real potential risk to global growth. You know, we're at the end of the Fed cycle nearly. We're always looking out for what's going to end it. What's the next crisis that could end it? Potentially, it could be a financial crisis in China. Are these the early grumblings of a big upset in Chinese growth?
So it's unclear. I mean, could we see like a frozen, I mean, if people are not asking for loans, is it because they're really worried about what's ahead and so everything grinds to a halt? And we've been hoping for PBOC to intervene. Is this finally the time where we're going to see something from policymakers?
Yeah, I mean, that is the call from so many analysts, isn't it? That they need to do more. They need to step up, either with benchmark rate cuts, further cuts to the RRR, the reserve ratio for banks, or additional fiscal support, whether that's to households or businesses. But again, it points to the fact that unless you get that momentum going, the mindset shift across Chinese businesses and households around additional optimism that's not there at the moment, it's not going to work. And the real estate story ties into this. Don't forget, it's about 20% of GDP if you lock everything in together. And the real estate story is tied to the banking story. They're on the hook for credit losses of around $260 billion, potentially, according to Goldman Sachs, the Chinese banking system. And again, real estate links into what's happening in the local government level. They are short of cash. China's now trying to shuffle the debt between local provinces and their local government financing vehicles. The infrastructure impulse isn't there. There are no big ticket projects for them to build out in terms of infrastructure, railways and roads. That's all being done. So again, the levers for them to pull and the creative policy making isn't coming through yet from Beijing.
And this matters for the rest of the world. It especially matters for the ECB and actually in Europe because of the closer links.
Yeah, the close economic links, but also China exports goods deflation. This could possibly mean we could be receiving deflation from China in a very strong way. I know that goods deflation has been declining in Europe and in the U.S. for a long time, but possibly that could be sustained through next year and help the ECB and the Fed get inflation back to target.
There you go. Team analysis. Everything you wanted to know about these new loans actually plunging to 2009 lows with Tom McKenzie and Valerie Teitel. Thank you both for joining us. Up next, Bloomberg Surveillance Early Edition with Kriti Gupta in New York, Danny Berger in London. They'll have plenty more on China. Of course, it's been a big week for treasuries. We had a lot of data out there. And then that big story in the banking sector with UBS. You'll have full coverage up next. Happy Friday, everyone. This is Bloomberg.
half of all American women in opposite-sex relationships now make the same or more than their husband. That's a record high. According to a new report by the Pew Research Center, a third of U.S. women are in egalitarian marriages, making roughly the same as their husbands, and another 15% of them are the breadwinners. Women with college degrees and no children, as well as Black women, are even more likely to make more or the same as their partners. But not everything is a bed of roses. Working wives still carry most of the weight of unpaid labor. Women in egalitarian marriages spend almost twice as much time taking care of the home or a loved one, while dedicating less time to leisure.
Women are continuing to go out in the formal labor market and contribute and are still bearing all of the load of responsibility that disproportionately falls on them in terms of family care.
During the pandemic, in the wake of school shutdowns, the height of the childcare crisis pushed nearly half of American women out of the labor force, a trend that's yet to be reversed.
Women are just really struggling to meet the care needs of their family, and at the same time are really, really leaning into the labor market. And I don't think we've seen this before in history, to be honest.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And then Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. A choppy week draws to an end. Mary Daly says the Fed has more work to do to control inflation, even after data for July showed modest price increases. Meanwhile, the UK economy delivered its strongest growth in more than a year, a surprising show of resilience that will keep pressure on the BOE to raise rates further. And U.S. President Joe Biden warns that economic problems have turned China into a, quote, ticking time bomb. Welcome to Bloomberg Surveillance. This is the Friday edition of the Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Kriti, it's only fitting that the 10-year yield did a round trip, not just yesterday, but for the full week. It exemplifies these fearful and edgy summer markets.
Yeah, I mean, look, you're seeing very low volume when it comes to just simply in the equities market and the bond market. I think the stat for the equity market, Danny, is something like only 40% of normal trading. So you are already seeing that summer volume kick in. But to your point, you're also seeing that bond volatility kick in, and that's really where you're seeing those round trip moves, given we do actually have a lot to move the bond market story. You've got geopolitics on the one hand, monetary policy on the other, not to mention the digestibility of all of these treasury auctions. We're going to dive into that in just a moment. A quick check on these markets, though. Futures virtually unchanged right now, and that's interesting because just a few minutes ago, we saw a bigger pullback in the equity market, perhaps reversing just a little bit. But again, summer trading, so really keep an eye on where futures end the day. 44.82 here, and again, it is a Friday, so to see a little bit of cashing out wouldn't be all that much of a surprise. When it comes to the bond market, though, I think the most action that you are seeing this morning is coming on the front end of the curve. The 2-year yield at about 481, already a move down about 4 basis points there. And again, there's a lot to digest. So we're going to get PPI data out later this morning as well. So you are going to see a little bit, again, of the volatility that Danny was just talking about. Let's talk about what happened in Asia, though, because we did get headlines here that you are now seeing new yuan loans at the lowest since 2009. And that is moving the offshore yuan. 724 is what we'll call that pair for dollar yuan. It looks virtually unchanged right now, but if you were to look at an intraday chart, it would show you a bigger move, really saying that, look, perhaps that loan market is slowing down. That isn't the amount of kind of strength that we are looking for from China at the moment. We're going to dive into that shortly with a reporter as well. And of course, always worth checking on the commodity market. An 86 handle on Brent crude, virtually unchanged at the moment. But again, the volatility is what matters. We did get comments out of the IEA today as well. They said, look, there is global demand, it's robust demand, but OPEC also has a lot of spare capacity. So really keep an eye on what Brent crude does, Danny.
There's a little bit of a head scratcher with that as it relates to European markets, because despite the fact that Brent, as you could see, there's little change, that commodity markets aren't doing too much today, those types of stocks, the commodity producers, the basic materials, energy stocks, are some of the worst performers today in Europe. And that's why the overall European index is looking weaker by about 0.7%. Perhaps it is just the fact that when Europe was closed yesterday, we got that slide in American equities. Of course, they didn't close lower, so part of it perhaps is catch up. But this interesting dynamic is arising after yesterday's CPI reading for not just the US, but the UK, where the inflation data is starting to look more promising. It's starting to come in line. And it seems like the concentration is now moving more towards the economic data. We got UK second quarter GDP and doing better than expected. Immediate reaction in sterling to strengthen versus the dollar. Your cable rate going up by 0.2% at 127. Meanwhile, in bond land, again, not a lot happening here. We are looking at continued selling in the German 10-year yield. Also, perhaps, Kriti, just another reflection of what happened yesterday when we got bear steepening across the board, kind of unwinding the initial CPI reaction.
Well, speaking of that CPI reaction, the data isn't over, Danny. We're also now going to get that PPI data out of the U.S. as well. After that, to your point, a slower core CPI figure. And this, of course, comes as Fed officials, well, they're staying pretty focused on their fight against inflation. Take a listen to their latest remarks.
To be sure, we are at a watershed moment in our economy. And I'm not just talking about the fight against inflation, in which we are making progress.
It's also consistent with what we believe will be happening, which is that inflation will gradually make its way down. But it is not a data point that says victory is ours.
We have been working hard in recent months to reduce inflation.
There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target.
For more on that story, let's bring in Bloomberg's Valerie Teitel. She is monitoring everything going on in the bond market right now. Valerie, there's a lot of cross currents here. We've got the CPI data, the PPI data, and then there's just the question of how well the market can actually digest the wave of Treasury issuance we got this week. Walk us through it.
Yeah, that's right. Yesterday, the follow-through to CPI was so much focus on the 30-year bond auction that happened yesterday afternoon. Came in weak, and after that, we saw the big reversal of this bid into bonds after that weak CPI print. It's even following through today. If you look at how the Treasury curve is trading, it's really that 30-year bond that's the weak point on the curve. It seemed to be a lot of excitement from traders from the market to reload into these steepening positions now that we have the CPI and that 30-year bond auction out of the way. We do have PPI today, Kriti, and the risk is that it shows us a different narrative. Now, higher oil prices, higher energy prices tend to have more of an impact on PPI, so there is a risk that it does come in hot based on that. Now, we didn't see that in yesterday's CPI print, so it would change the narrative slightly. We also get UMISH inflation expectations. We know those are very much tied to prices at the pump, which have been rising recently. So perhaps later this afternoon in this data dump from the U.S., the narrative does change slightly.
Has the narrative changed, Valerie, for the UK with this second quarter GDP print now in hand that was stronger than we'd been expecting?
A strong set of data from the UK across the board. Now, that growth surprise does bring with it some inflation risks, but I mean, better than expected data across the board. Industrial production, manufacturing production stronger than expected. And the reason for that uptick in that GDP for June was consumer spending. It saw the biggest increase in over a year. We know that if the consumer's still out there spending, that's pressures on core inflation are likely to subside a bit longer. Hence, we saw such a rise in UK yields and that drag higher in sterling, which you pointed out earlier. But again, surprising to see this from the UK. We have had a string of weak data. Maybe that's done for now, and we refocus a bit more on its growth impacts of inflation.
Someone sent to me this FT article that basically showed
note, in the UK, if you stripped out London, per person, growth in the UK is worse than Mississippi. So that's how it would rank compared to the US.
It's us here in London keeping it strong.
You and me, exactly. Yeah, I think that's right, the Americans in London. Valerie, thank you so much. Valerie Teitel there with the latest eco data. All right, let's move over to Switzerland now. And taxpayers in the country are no longer bearing any risk related to the rescue of Credit Suisse after UBS voluntarily decided to end an agreement with the government to cover losses. They've also repaid a loan they received. For more, let's get to Bloomberg finance reporter Marion Haftemeyer in Zurich. Marion, why and why now?
It's a good question. So why, for UBS, this is really a show of strength. You know, you see the share prices going up today because of this announcement. They are essentially saying, you know what, after finally doing the due diligence on Credit Suisse, we think we can handle this and we don't need the government help. Now, this is probably a quite welcome decision from the Swiss taxpayer because they were on the hook for potentially, if there were going to be more than 5 billion and 9 billion of losses with respect to this deal. It also helps UBS, from their perspective, say, you know what, this is purely now a commercial private transaction and the government doesn't have a role in this anymore. And so they are freed, and so to speak, to do what they need to do, want to do to make this transaction work.
Marion, is there any world in which UBS needs to actually reach out to the Swiss government again, where maybe they will actually need that financing? What is kind of the doomsday scenario here?
I think that probability is very, very, very low at this point, else they would have kept that guarantee. I mean, keep in mind, this guarantee only actually kicked in after UBS first took 5 billion in losses. So we're looking at like a $14 billion loss scenario. And for them, you know, they've had a couple months now, the merger officially closed in June. They've had a couple months to really dig into all the things they thought might be concerning at Credit Suisse and have realized, you know what, we can handle it. I don't know if that means they're going to reach the 5 billion, but they certainly didn't think they were going to go over 5 billion and therefore tap into this government guarantee. So in terms of going forward, I think we can trust that things will not get to a point where they need the government to get back involved.
And that's pretty quite clear as you're already seeing the market trade higher. I think 5% shares when you look at those that UBS move. Bloomberg's Marion Haftemeyer joining us from Zurich. We thank you as always for walking us through the story. From Zurich, we go to the Pacific, or at least Washington's take on the Pacific. President Biden blasting China's economy just days after signing an executive order to regulate U.S. investments to the nation. The president called China's economic problems as, quote, a ticking time bomb and referred to Communist Party leaders as, quote, bad folks. Let's get more from Bloomberg Asia government and politics correspondent Rebecca Chung-Wilkins joining us right now from Hong Kong. Quite a turnaround for President Biden. Rebecca, what is he thinking?
Certainly some exuberant comments there, and also worth noting to a home audience, so not to sort of an international audience on the world stage. But as you say, some of his most direct criticism of China yet, and some things that were just wrong. His sort of number about Chinese growth, for example, the number of the population who's retired was off by several hundred million. So it's certainly not necessarily a comfortable place for Biden to be. Worth noticing, though, that there's been very little response from China so far, either on social media or local media. And you sort of have to wonder if China's avoiding forcing a situation where it has to respond to this. But the timing is interesting, as you say, because it's just come off the back of that executive order, which actually some may say that Beijing probably sighed a bit of a relief over that. It was slightly more targeted, narrower than was expected, and exactly precisely along those lines that we think Beijing was sort of lobbying Janet Yellen on during her visit to Beijing recently.
Rebecca, we're still on Country Garden watch. Officially a penny stock now, dropping again. I mean, it dropped 6% today, but that is a loss of 6 cents. So that's important context there, looking at those losses. We knew that China regulators were going to be meeting with different property developers, though not Country Garden. Where do we stand on this? Has the dial been moved at all at this point, or are we in still max concern mode?
Well, I think for Country Garden itself, clearly you can see that investors, looking at the bonds, for example, are pricing in not just a default, but a scenario where they really return very, very little in any kind of restructuring scenario. The notes are around 6 or 7 cents on the dollar. Just to put it into context, Evergrande's sort of about 5, 4. So I think you already have sentiment really reflected in the pricing there. But more broadly, I think emphasis will shift longer term, that if we do see really strained finances at Country Garden, even if they avoid an official default, there will be this focus on whether or not Country Garden is going to be able to deliver all of its homes. It has 4 times as many projects as Evergrande, about 80 million square meters of pre-sold apartments that it needs to deliver. And there is this slight social unrest issue too. We saw these mortgage boycotts happen when Evergrande defaulted and failed or struggled to deliver homes that it already sold to people in China. So just a couple of things to watch.
Well, speaking of things to watch, Rebecca, the story that caught my eye out of China, among the deluge of news coming out of the Pacific at the moment, is that thousands of hedge funds in China could potentially get shut down. Let me read this quote, if I can, for our audience. About 37% of all existing hedge funds are smaller than even half of the 10 million yuan minimum asset requirement. Rebecca, this is a massive change when you're looking at the hedge fund universe. How does this play out?
Absolutely. This is a really interesting story. I'm glad you flagged it. Yeah, it looks like these rules that are going to come in as soon as September essentially going to wipe out or force a lot of these smaller players to liquidate and then also impose stricter rules on the larger players. Now, over the last decade, the hedge fund industry in China has really grown about 7-fold. And compared to its sort of global other comparisons, it does have a sort of more populated, more densely populated landscape. But we have seen Beijing over the years kind of look to try and professionalize and consolidate in these types of industries. So really looks like hedge funds are going to be the focus for now.
Rebecca, thank you so much for all of that. Rebecca Chung-Wilkins in Hong Kong. Now, coming up, we're going to be catching up with Aberdeen Investment Director Luke Hickmore later this hour on how he's thinking about markets after that CPI report. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Let's get to some important developments from the U.S. and around the world. Starting stateside, the Supreme Court agreed to hear a U.S. appeal of Purdue Pharma's $6 billion opioid settlement. The Biden administration contends that the accord improperly shields the Sackler family, a member who owns the company. The High Court review could threaten Purdue Pharma's bankruptcy reorganization plan, which includes the opioid settlement, as well as an agreement by the Sacklers to give up ownership of the company. Danny, this is an enormous story. Of course, we know the Sacklers have been associated with the opioid crisis in America. Now, this halting from the Supreme Court could mean that simply their move or their litigation is long from over.
Now, elsewhere in the U.S., Kriti, Hawaii's governor says 53 people have been killed in wildfires that tore across the island of Maui, with that number likely to rise. Fast-moving flames swept the island, destroying hundreds of buildings and sending people fleeing into the ocean to escape. The National Guard and Army have joined search and rescue efforts, with the main fire now 80% contained. President Joe Biden says he is rushing federal support to Hawaii.
I've ordered all available federal assets on the island, including the U.S. Coast Guard, the Navy 3rd Fleet, and the U.S. Army, to assist local emergency response crews along with the Hawaiian National Guard. We're working as quickly as possible to fight these fires and evacuate residents and tourists.
And from Hawaii, we go to Iran. Iran has moved 4 U.S. citizens from prison to house arrest as part of a potential swap. Joining us for more on this historic story, Bloomberg's Patrick Sykes joins us. Patrick, walk us through the latest updates. Where are the prisoners now? Are they free? What do we go from here?
That's right, yeah. House arrest is the key point there. They've been released from prison, but they're very much still in the country, and they're under house arrest in Iran. That's interesting, and it differs from previous prisoner swaps or prisoner releases, where usually we've only found out about them when they leave the country and it's a done deal. In this case, it looks like things are going to be a little more sequenced.
Well, what are the details that still need to be agreed upon, Patrick?
Right, so the Iranians are saying they want $6 billion of frozen assets that are held abroad to be released, and they're saying they won't release the prisoners until they get that. And that's oil money that Iran has from its oil sales abroad, but which it can't access because of US sanctions. And the prisoners are only going to be exchanged after that. Exchanged, also an interesting point. The Iranians calling it a prisoner exchange, the US not using that language. So we've also got to watch for, from the US side, who are they going to release and when are they going to release those? Any hiccups in that sequencing could risk a broader deal.
Patrick, you make a crucial point, essentially that there are so many hiccups here. Is this the start, though, of perhaps some more kind of diplomacy between Iran and the U.S., just given they're not exactly on speaking terms?
Quite. I think this sequencing that I mentioned is testament to the real lack of trust between the two sides, especially after the effective collapse of the nuclear deal. So the answer to that question depends if things go smoothly, if everyone does what everyone else expects of them, when it's expected, then I think there's room to build some trust, and perhaps from that they can leverage some broader diplomacy. But if there are surprises, if the Iranians don't like the timing, if the Americans can't handle the political messaging of potentially releasing funds to Iran around an election cycle, then there's room still for things to fall apart.
Patrick, thank you very much for that update. That's Bloomberg's Patrick Sykes in Istanbul. Now, coming up, Telecom Italia rises as the Italian government signs a prelim agreement with KKR to grab 20% of the company's network. We'll have more on that story next. This is Bloomberg.
markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis, we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Kriti Gupta in New York. Now, some deal news. KKR has agreed to include the Italian government in its 23 billion euro bid for Telecom Italia's network. The Treasury may get as much as 20% of an asset it deems strategic. Now, Kriti, this is Giorgia Meloni's second major move this week. Earlier, in a move that upset Italian banks, it imposed a windfall tax on the banks. And again, it's really significant how much of corporate Italy she really has her hands on in this moment. When it comes to Telecom Italia, they do consider this a strategic asset. So for any deal to come through, Italy really wants that veto power when it comes to things like, certain assets, buying, selling. But originally, Kriti, the media reports from local media was that Italy would get a 35% stake. We're just talking 20 now. So perhaps for Italian government watchers, it's a bit of a disappointment. They're not going to get as much from this deal as initially expected.
Yeah, I think the broader context is important too, Danny, because it's not just KKR that's looking at this, for example, or the Italian government. It is also the likes of Vivendi, for example, the major telecom company coming out of France as well. I also have to mention, this is something that has been a sticking point in Italy for almost a decade. This infrastructure that they haven't really been able to fully develop and fully kind of advance in an era where even stateside you're seeing the 5G network, for example, get a really big boost. Italy is far behind, and a lot of that is simply because they're shifting the strategy and the plan on how to actually tackle that, and this won't necessarily help.
Yeah, and on the Vivendi front, they are Telecom Italia's largest shareholder, and their sticking point has been, hey, we say this thing is worth 30 billion euros. Last time KKR looked at it, it said it was worth 23 billion euros, according to the deal plan with people familiar at the time. So Vivendi not too happy about that one either. All right, coming up, we're going to be speaking to Aberdeen Investment Director Luke Hickmore. This is Bloomberg.
brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A choppy week draws to an end. Mary Daly says the Fed has more work to do to control inflation, even as data for July showed modest price increases. Meanwhile, the UK economy delivered its strongest growth in over a year, a surprising show of resilience that's going to keep pressure on the BOE to raise rates further. And meanwhile, in the U.S., President Joe Biden warns that economic problems have turned China into a, quote, ticking time bomb. I'm Kriti Gupta in New York with Danny Berger in London. Danny, some powerful words coming from the president there. He's also juggling, of course, the wildfires in Hawaii, the Iran prisoner exchange as well. And yet the markets seem fairly quiet.
I got to say, it feels kind of silly to talk about what European stocks are doing right now when we're talking about prisoner exchanges and fires. There's a lot of important things happening in the world, but we are Bloomberg, so we got to give you a check on what's happening on these Friday markets. They do feel squarely like Friday summer markets. I mean, not a lot to move them, right? We're kind of mostly done with earnings. We got the big CPI report out of the way yesterday. We are drifting lower in the European session, down about 0.7%. The one thing that was able to shake things up today was that UK GDP report for the second quarter coming in stronger than expected, perhaps giving the breathing room for the BOE to hike more. Maybe breathing room is the wrong word, because, surely they are concerned about needing to hike more, about the issues of getting inflation under control. It's remarkable how much the economic data is taking the mantle of importance away from CPI data, away from other inflation data. Sterling strengthens about 0.25%. Meanwhile, German 10-year yield following a lot of the action we saw yesterday in the U.S. in terms of declines. Yields are up by about 4 basis points. Again, we saw that big bout of bear steepening yesterday, Kriti.
It's interesting that we're seeing that kind of acceleration of selling in Europe, because when you look at what's going on stateside, it's not the same, Danny. You're seeing futures down, marginally, down 0.01%, 44.85 on those contracts. A little bit of underperformance from those NASDAQ futures, though. The bond market gets interesting, to your point, because we, of course, have that PPI data later in this morning. 2-year yield at about 4.81, moving down by about 3 basis points. But again, the PPI data could change that. What happens if it's at odds with the slowing CPI numbers we got yesterday? Let's talk a little bit about what happened in Asia overnight, though, because if we're talking about a potential slowdown in the inflationary or even the growth dynamics in the U.S., we're certainly seeing them in China. China actually releasing that their new yuan loans are now at the lowest since 2009. That is not a metric that strikes a fun chord with a lot of investors. Nevertheless, that is weakening the offshore yuan. So you are seeing dollar yuan at about 7.24. We'll call it 7.25 this morning. Brent crude as well, also trading just shy of an 86 handle, down about 0.5%. The IEA coming out with some comments saying, look, demand is good, demand is robust, but OPEC does have spare capacity. So there is room, potentially, if they choose, for prices to come down a little bit.
Kriti, I do want to show us what the session has looked like over the past 2 days with the 10-year, because just looking at the level we're at now really belies the volatility we saw yesterday. Okay, so here's your 2-day. The session is a little bit shorter today because Japan was closed this morning, so we didn't get the cash trade until a little bit later on. I digress. That big drop we saw in the middle of what says 10 there, in the 10th of August, was that CPI report. The initial reaction to core month over month hitting what was expected, showing disinflationary trends, was a relief rally. Now, if you, though, woke up today and didn't look at the trade, you would have expected that CPI came in hotter. Because about 30 minutes later, you saw the rally not only undo itself, but turn into a sell-off. We have come to a round trip. We've come back to 4% on the 10-year yield. It is a bit of a head-scratcher. Let's see if we can make heads or tails of it. Joining us now is Luke Hickmore, Investment Director at Aberdeen. Luke, I look at that. Do I say, look, this is a market that's decided inflation is going to reaccelerate, or should I look at that and say it is the summer, markets are weird, there is no information contained within that price action?
I think it's possibly bits of all of that, which is always difficult to put your finger on one thing. However, I do think we're seeing this bear steepening trade. That's reflecting the market shifting to a higher for longer Fed view, maybe just 25 basis points more, but they stick there for a long time. That should steepen up curves. That pressure has been going on for about a month. It's probably one of our favorite trades, by the way, steepening trades. So that's going to push up those 10-year kind of numbers anyway, on top of which we had the 30-year financing yesterday, which was a bit soggy, and the action around it didn't feel very comfortable. And it was around that point that we saw yields start to tickle up in the 10-year, on top of which holiday, absolutely, that causes volatility.
Do you think this market, though, might soon shift to a grind lower in growth, Luke? And part of the reason I ask that is this narrative that's arrived around the fiscal support blanket that's been laid on top of the American economy, that at some point we run out of that and we face the reality of tightening monetary policy. Is that a reality? And will that begin to be a trade that's put into this market?
I've been looking for a recession for so long. It feels, I still think we're going to get there. I think all that's happening is we're just pushing it out in terms of time. And that fiscal comfort blanket is certainly part of the story. The high level of savings is part of the story. That great resignation that we've been going through since COVID is part of the story, all of which is fading. And I think as inflation comes down, of course, nominal growth comes down too, revenues go back to kind of flat year on year, if not negative, as we get later into the year too. So I'm sticking with, it's really hard for the Fed to raise rates this hard without a recession coming along. There is very little evidence in history that they've been able to get a perfect soft landing once, maybe twice in 100-odd years.
Well, Luke, as we know, as part of economic cycles, recessions are inevitable. So at some point, you will be right. Let's talk a little bit about just the growth story again that Danny was talking about. She mentioned fiscal support. I'm curious about fiscal support as well, not from the U.S., but from China. If we look at the recovery in the last global financial crisis, a lot of that came from Chinese stimulus. Is the Chinese stimulus or the Chinese read-through the same as it was now as it was then?
No, I don't think it is. That rescue the world got during the global financial crisis from China was so important. I don't think we're there now. The growth potential in China is lower now than it was back in 2008, 9, 10. I think the more focus that they've had on domestic growth has changed the pattern a lot as well. And clearly, we've seen the early foothills of both onshoring and friendshoring, shifting manufacturing away from China. So to get a stimulus to work, especially with the housing crisis that's been going on in terms of values in China over the last year or so, they need to do more to get the same level of growth. And I'm not sure they've got the appetite or maybe the capacity to do the amount that they need to do to get back to a 5 or 6 or 7% growth rate that we've seen in the past, just domestically. So it's really hard to think that spills over to the broader economy, which is what, of course, we saw in the GFC. So no, I don't think so this time.
You're talking about the growth spilling over. Let's talk about perhaps the lack of growth spilling over. The story of China actually exporting deflation. Is that something that's going to have a more powerful read-through? Is that something that the likes of Powell and Lagarde are actually going to welcome?
Of course, to a degree. But as I said, I think its impact has waned a lot more than it would have done in previous years. It's a bit like the oil story in the 70s. It was all about oil price and inflation. And now, we're a lower carbon intensive economy than we have been for a long time. And we are now a lower Chinese intensive economy than we have been for a long time. So it'll make a difference on the margin. But I think inflation comes back to the core domestic drivers, particularly in the US, wages, jobs, growth, consumers actually having the will to go out and spend.
Luke, in terms of what can really ignite volatility into this market, it seems like the point of focus keeps changing. At one point coming out of COVID or during COVID, it was jobs. It's been inflation, CPI figures for a while. Does that now shift, given our continued confusion and concern about a recession, does that now shift to the growth data being the thing that you want to trade?
I think so. I think that narrative about a soft landing is going to be changing as we go through the next couple of months. It's seasonal as well. The September-October season can be pretty tricky for equity markets, rethinking their growth expectations. I think people are going to withdraw, actually take them down quite a lot. On top of which, and the one that's not really started to be talked about yet, sovereign risk. We've seen one downgrade in the US. The amount of sovereign debt is still incredibly high. Lower inflation makes that actually a bigger problem for governments. We could well see more rating action on the sovereign side over the next year as well. And markets will need to react to that too. And that's a hard one when these are our risk-free curves.
Yes. Wait, can you walk me through that scenario? Is it further action on U.S. sovereign debt, or does this sort of begin a snowball effect of more global sovereign debt getting a relook?
Without being too harem-scarum, yes. So it definitely starts with the US. It definitely starts with the reassessment of political volatility that we're going to see next year. The amount of fiscal stimulus that we're still going to be paying for in the US for ages, of course. The amount of debt, they got that over 100% debt GDP kind of numbers that they're in. And this, of course, is nowhere near worrying about a default, but it only takes these small moves in rating agencies at the sovereign level, particularly in the US, to start rethinking the UK, France, Japan, all of whom have got very large fiscal deficits as a percentage of GDP. So I think that is something investors need to put on their radar, thinking about that sovereign risk over the next 6 months, 12 months.
Luke, we're about 4.5 months away from 2024 when the presidential cycle in the U.S. really kicks up. And then a few weeks after the presidential cycle, we're again in the midst of the debt ceiling debate. Is that something that the market should be worried about right now?
It always seems to worry about the debt ceiling debate as we get near it, and then we get past it and moves on. And it feels that there is a point when that is going to become really, really sharp. And it has to be around the political cycle that is going to be so intense in the US next year. I think that is something, I haven't got the dates in mind, and I'm going to have to get completely up to date on the dates for the next debt ceiling debate, because I think next year's ones are going to make the ones we saw with the volatility this year look actually a bit of a walk in the park.
Oh, boy.
Yeah.
Not
Sorry to be so negative, but, it's holiday.
It's a Friday, Luke. It's a Friday in the summer.
Sorry.
We need more cheer from you.
Yeah, the timing, not fantastic there, whoever scheduled that. Aberdeen's Luke Hickmore, we thank you, as always, for joining the program and keeping a little bit of modesty, perhaps, in these market calls. Coming up, Mexico kept borrowing costs unchanged for a third straight meeting. We're going to discuss that and more in the world of emerging markets. Graham Stock, Blue Bay's senior sovereign strategist over at RBC Global Asset Management, joins us next. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And then Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Kriti Gupta in New York. Now, Mexico kept borrowing costs unchanged for a third straight meeting, pledging to maintain its current stance. Joining us now is Graham Stock, Blue Bay's senior sovereign strategist at RBC Global Asset Management. Graham has over 2 decades of experience over in emerging markets, sovereign strategy, with a particular focus on LATAM. So, Graham, let's focus on LATAM. Look, Mexico holds in this decision, but we've already had a cut from Brazil, a large cut, I should say, from Brazil, from Chile. It's kind of ironic that despite that, I was just looking at a Bank of America survey of global monetary policy. The biggest concern is a mistake. What do you make of that? How vulnerable are LATAM nations at this moment to a monetary policy mistake as they embark on a cutting cycle?
I think they have some room. They've got much larger reserves than they had in the past. They've hiked rates aggressively in the tightening cycle. So there's quite a big margin between the real rates in LATAM and, say, in the United States. So there's some room for maneuver. Currencies have been quite strong, so there's room for a bit of weakness in the Mexican peso or the Brazilian real, for example, without that feeding back into an inflationary loop. But at the same time, they want to make absolutely sure that they bear down on inflation expectations. And that's why Banxico kept rates unchanged at 11.25 last night, as you say, for the third meeting in a row. And why they signaled that they're going to remain data dependent and cautious around the outlook until inflation expectations come back into line with their target.
You mentioned the weakening dollar. It does feel like it's run out a little bit of a steam, or at least we've taken a slight pause in that trend. How necessary is it that we continue to see dollar weakness in order for LATAM nations to have that breathing room to continue to cut?
I don't think it's a precondition. I think the more important element is the domestic inflation dynamics. Some of the price pressures from high food and energy prices are falling out of the indices quite quickly now. But the key is whether core inflation starts to behave better. So just like in the US, like in Europe, core inflation is the concern, and that's the reason why inflation expectations are still above targets in many cases. It was striking in Banxico's statement last night that for the first time they did mention peso strength and the impact that's had on inflation over the last few months. I think they can tolerate some weakening of the peso, strengthening of the dollar without worrying too much. But again, they need to see those forward-looking inflation expectations coming down further. I would expect them to be ready to cut probably in November, but maybe not even until the beginning of 2024.
Graham, you mentioned essentially the super peso, and it's such a popular trade at the moment to kind of capture the carry in the Mexican peso or even in the Brazilian real versus a currency like the Japanese yen. But I'm curious how much of that risk appetite is going to wane if you start to see a lot of these Latin American central banks pull back and perhaps signal a pullback in some of the developed world as well.
I think, again, that they have quite a big cushion to work with. So in Mexico's case, for example, with the policy rate at 11.25 and inflation running at just below 5%, the real rate is 6.5. So that compares very favorably with the US real rate ex post, which is around 2.3. In Brazil, the real rate is even higher because inflation is running lower and their policy rate is higher. So I think they have plenty of room to cut without jeopardizing that carry trade. But it is something that they'll certainly be mindful of. And again, though, it's the domestic inflation dynamics that are their key driver here, and that's why that's the data that they're going to be watching in particular. Mexico, of course, has been favored by relatively buoyant activity. Remittances have been very strong as a result of the strong U.S. labor market. We're seeing some nearshoring, which your previous guest mentioned, relocation of manufacturing activity away from China to Mexico in particular, but also other parts of the region. And that's all helping activity. That means that your core price pressures will remain for a while. But as the temporary price effects from the conflict in Ukraine and from COVID reopening start to fade or continue to fade, that should be supportive. The one risk factor, the additional risk factor that I think we need to keep an eye on is El Nino and the impact that could have on food prices, which again should be temporary, but particularly in Latin America and indeed other emerging markets where food is such a big component of the CPI basket, it's not something that central banks can look through entirely.
Graham, you read my mind. I was just about to ask you about those food prices because if you actually do look at them, they've come down a little bit, but not as much. And the exposure, as you mentioned, is enormous for the world of EM in a way that it doesn't necessarily have the same read-through to the American or even the European consumer. What does the Federal Reserve, or excuse me, I should say a central bank, an emerging market central bank, actually do about that? Because rates aren't a direct tool to tackle food inflation.
No, absolutely. And so they have to keep their focus on core measures and on inflation expectations. And that's why they've hiked more aggressively through the hiking cycle. They started hiking faster than developed market central banks. And now they're in a position to consider easing again. But because they have taken that aggressive action, they hiked in bigger increments. And again, Mexico's policy rate is 11.25%. Brazil's is close to 13. So there's plenty of cushion there. They've moved aggressively already, and they're going to be cutting with extreme caution, again, as we saw from Banxico last night.
Graham, a final question on the politics of it all. Of course, we're watching the political situation in Ecuador unfold after the assassination of one of the candidates. What is the read-through in terms of the markets when we're looking at that kind of volatility?
Unfortunately, political noise is something that we're used to in emerging markets. This is an extreme example in Ecuador's case. But I think they probably will hold the elections as planned on August the 20th. It could even lead to a more market-friendly outcome if some of the other centre-right candidates are perceived as being tougher on security. But it's a scourge for the region as a whole. There are huge concerns around the security situation, particularly fueled by drug gangs, driven by demand for drugs in the developed world. And it's something that Ecuador has not yet managed to tackle successfully. It took Colombia a very long time to address this, dating back to the late 80s. It's a continuing problem in Mexico. It's something that's on the radar for the political systems all across Latin America, but is again a very difficult thing to address. But again, I think the elections will go ahead there on the 20th of August. We've got primaries in Argentina this coming Sunday, which will be an important signpost on the road to the general elections in October there. I think the general theme in Latin America is still a desire for change. So whoever the incumbent is going to face a very difficult battle retaining power in these elections because they're simply not managing to satisfy popular demand, whether it's for security or for improved living standards. So we would expect a change of government in Ecuador and also a change of government in Argentina when those elections roll around.
Certainly a lot to digest in the EM world. Graham Stock, all over that. Blue Bay's senior EM sovereign strategist over at RBC Asset Management. We thank you, as always, for joining the program. A lot to digest on the macro and micro front. Stick with us. Your trading day ahead. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Preeti Gupta in New York with Danny Berger in London. Danny, it's a little bit quiet in the markets, but there is still a couple of things to watch. Of course, we have those PPI numbers coming up at 8:30 a.m. New York time. We also have Neil Kashkari speaking over at about 11 a.m. New York time, and of course the Fed minutes coming out next Wednesday as well. I got to come back and circle about the PPI because I think this is really important. We put so much emphasis on the CPI story, and now we got to talk about producer prices. I'm reading our Anna Wong, our chief U.S. economist, kind of preview of this. She's talking about higher oil prices, higher shipping costs stemming from the Panama Canal. Danny, this isn't something we talk about, but there's a very real read-through into the numbers we might get today.
Yeah, and look, if there's any surprise to the upside, it kind of challenges some of the narrative that the CPI laid out yesterday. But it's clear that this market unwound positioning for re-acceleration of inflation and then put it right back on. I think it was really interesting what Luke Hickmore said about this idea that it's not necessarily the inflation data that's the important thing anymore. It is the growth data, as Thanos Van Vakidis over at Bank of America just put it in a note. We don't believe in miracles. They don't believe in the miracle that inflation can be coming down without growth taking a hit. So it's that growth data that's starting to become more important, Preeti.
Yeah, where's the read-through from around the world? Perhaps something that surveillance will digest ahead. That does it for Early Edition. Tom, John, and Lisa take it from here. Stick with us. PPI ahead. This is Bloomberg.
Capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift
that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
It's hard to see where this recession is going to come from.
We're going to be in this 3 to 5% inflation environment for the next 3 to 5 years.
I do think that there's probably a little bit more disinflation in the pipeline.
I think it's appropriate for the Fed to take a pause here and see.
I'm so convinced that inflation is going to get down to 2% on its own, with or without any help from the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market slightly negative on the S&P 500. I think for the second or third time this week, waking up and looking at China, to the data and some of the commentary around that economy right now. New loans extended by Chinese banks on a monthly basis. TK plunging to the lowest since 2009. There are real legitimate concerns about what is developing in the world's second largest economy.
Like any other financial instrument, you look at the income statement dynamics and the balance sheet statement dynamics. And I agree with you. I mentioned this, I believe, yesterday or the day before in our China frenzy, that the flows on the balance sheet in and out are what matter. And this is FDI from us to them, off a cliff, from them to us. Maybe not a cliff, but it's down.
The data dropped in the last hour or so, and Lisa, the response pretty clear from many people on the south side. SocGen went in. This is going to lead to more stimulus out of the PBOC and maybe out of China more broadly. We'll see, because we haven't seen it large scale just yet.
What kind of stimulus at a time where they're very concerned about the debt load at a lot of the local governments? I mean, this to me is the conundrum for China right now. If they want to move away from leverage, if they want to create a more sustainable economy, how do they then stimulate an economy where you look at some of these local government debt piles that one Goldman Sachs estimate has at $13 trillion outstanding?
And this is really important. I mentioned this recently, and I got some heat for it. Some people emailed me in and said, I don't know what I'm talking about. Federalism in China is different than here. It's not like a federal government, the capital. It has always devolved to the cities. The critics will say it borders on an organized structure, whatever. And Shanghai gets a focal point, but my knowledge base is that there's got to be more than just Shanghai involved. These cities are troubled.
Should we get to the president's comments at a fundraiser yesterday evening with this to say that China's economy is a, quote, ticking time bomb, and referring to leaders in the Communist Party, Tom, as, quote, bad folks. Bad folks. I thought at a time the administration was trying to shore up ties with the Chinese government. That's not going to help out that cause at all, if that is the objective.
On the next break, if we're not talking about Harry Kane, I will put out an article in the Foreign Affairs magazine from 8 months ago that goes to what the president's alluding to. We need to be delicate on air. There's things we can and cannot say, but there is this gauze of how did Mr. Xi become Mr. Xi? how did the leadership in China become who they are? And the president alludes to that in terms of organized political
Are you
systems.
censored? Is that what you're saying?
I'm censoring myself. I've
Okay.
got John Micklethwaite's in my ear right now. Tom, shut up.
Well, you're censoring yourself, but Joe Biden didn't censor himself.
the
and this
president
is really
doesn't
the
have
question
to.
that I
Yeah,
have. Well, does he not have to, really? Does this really fly with the economic policy that they're trying to do? I mean, you're trying to toe this line between saying we're going to try to repair relationships and create some sort of communication to avoid some error, and then bad folks, ticking time bomb. I mean, it's not going to exactly go over particularly well.
Can I share this line with you that the president also shared with potential donors yesterday? China's in a position where the number of people who are of retirement age is larger than the number of people of working age. Now, if you're in the business of correcting politicians, you'll be very, very busy. But on that particular line, we've even had to write in the story this morning a statement that was not only incorrect, but also off by hundreds of millions of people. TK, you do wonder, when the politicians start talking about the economy, where do they get some of these lines from that just don't stack
They're playing to their
up? You
audience.
can't reconcile
John,
with
this is-
reality.
This is absolutely the heart of the matter, is they're playing to the domestic audience in the United States of America. And the China people we talked to, I think a China Beige Book is just one example. They're looking at far more than just 3 cities on the Pacific Rim and what we think. I had an offspring once, and I said, where are we going? And he mentioned some city I couldn't pronounce.
Losing count of children.
Well, this is cash flow.
Exactly.
I'm talking to cash flow, and I go, where are we going? And we're going to some city I can't pronounce. And I go, well, what is it? And he says, it's one of their 14 Pittsburghs. And that's China.
Yeah.
It's one of their I'll always remember that, 14 Pittsburgh.
Let's turn to the price action this morning. Good morning to you all just tuning in. In the equity market on the S&P 500, negative here by 0.1%. Actually heading for a second week of losses on the S&P, which, believe it or not, is the longest weekly losing streak going back to May. In the bond market, yields are lower by a couple of basis points on a 10-year 4.09%. I think we could call it that. Yesterday, yields up and away, Bramo. Even after that CPI print, it was about San Francisco Fed President Mary Daly pushing back a touch, and also that issue at the longer end, the 30-year auction, just a bit softer compared to the 10-year and the 3-year before it.
Selling at the highest yield going back to 2011, raising questions about the longer-term fiscal prospects. The latest read on inflation today, 30 a.m., we get U.S. PPI. This is the input prices for a lot of companies. It has fallen off a cliff, going to zero, basically, until now, and it's actually expected to stabilize and tick upward, particularly with the increase in oil prices and commodity prices, which I think is a major theme. Mohammed Al-Arian was great on this yesterday. 10 a.m., University of Michigan sentiment survey related to this. How much does it roll over as a result of higher oil prices? And at 12 noon, this is sort of on the peripheries, but it's not. World agricultural supply and demand estimates come out for corn, soybeans, cotton, and wheat. An hour later, we get rig counts from the Baker Hughes rig count data. And I want to understand whether we're reaching an inflection point upward with food costs, particularly with wheat. We've heard about some of the supply concerns there. We've heard about rice. How much does that become a persistent story in the backdrop, kind of fueling a little bit more inflation of the very bad kind?
Lisa, thank you. Dan Morris joins us now, I'm pleased to say, out of London, Chief Market Strategist at BNP Paribas Asset Management. Dan, is it too early for this Fed to declare victory?
Oh my, yes, definitely. We don't see really any possibility for the Fed to be cutting rates until next year, and that's even under, I think, a fairly benign scenario for the outlook for inflation. They're really going to want to see a trend in the headline figure. You know, it is moving in that direction, but we got a long ways to go before we get to 2%.
And Daniel, BNP Paribas, I think, is a view, a global view, a U.S. view that people are very comfortable with right now. We're really not believing the good news of disinflation. What do we have wrong in our interpretation that disinflation is in place?
Well, I think what's notable with the CPI data that we got yesterday, which really was about as good as you could hope for. I mean, it was around expectations, but if you look at the core figure, when we've had monthly core inflation under 2% for 3 months in a row. So that's really encouraging. Now, of course, there's a question about what's happening with shelter prices, but you know, the market should have, we think, reacted more positively. And I think it's notable that, particularly, say, with tech stocks, with NASDAQ, you didn't really see any bounce. And really what's driving Tech stocks has been the expectations for policy rates and inflation. So I think for us right now, it's more a lot of good news has been priced in. Growth is still going to slow whether or not we get to a recession. And I think that's what we need to price into U.S. equities.
Where to invest now? Take the econobabble of a Friday in August and give it over to an investable belief for Q1 of next year. Where do you place marginal assets now?
We're probably most optimistic on the outlook for U.S. rates, both nominal and tips. If you look at the level, well, really the level we were at a week or so ago, or in the last few days when we got above 4%, over 2% on real yields, we thought that was quite attractive, increased our overweights to those sectors. It's already started to come down, but we think there's more potential there. Again, we've got to price in either lower inflation or lower growth. And you're at levels that are historically pretty high, both for nominals and reals. And we think the outlook there is probably on a risk-reward basis the most attractive.
Dan, I wonder what your take is on the price action that we've seen over the past couple of weeks. John was mentioning that we could be poised for the first back-to-back losses on the S&P. Going back to May, you can see the biggest potential back-to-back losses on the NASDAQ of the year. Is this a reset moment, or is this basically the one drawback that people are going to get, that everyone's going to swoop in and buy?
I think that'd probably be a bit too optimistic. I think a lot of it is how the markets, or really where expectations were at the beginning of the year, when it was just all this talk about the recession and the slowdown, the last place you wanted to be with equities. And that's clearly turned out not to be the case. But now that the market swung to being much more optimistic about the outlook, buying into a soft landing narrative, when you've already had 40-some% gains in the NASDAQ, it's hard to see that continuing from here. So we're expecting subpar performance for U.S. equities for tech stocks, and are looking still for potential out of EM Asia and still out of China.
So are you selling aggressively on the margins when you take a look at where the gains are to lock it in anticipation of what you expect to be a tumultuous end of the year?
We've already gone underweight on the U.S. I don't think the expectation is necessarily to increase the underweight. I think we're pretty happy with that right now, and just really looking for the overweight that we have in EM Asia and China to materialize. And given the data that we've had recently that you guys were discussing, it may not come immediately, but we're still optimistic that will materialize between now and the end of the year.
Dan, I wanted to turn to one feature of the conversation that's dominated this week. It's pricing power in America and labor power as well. Dan, where do you see that pricing power sector to sector in the United States right now? Who's going to be able to get margins not only to hold up, but maybe even expand in the next year or so?
Well, certainly that margin expansion you can see in the expectations for earnings growth or consensus estimates for earnings growth, and we're probably not quite so confident that that's going to come through. So we think the risk is that actually that doesn't happen, that you don't see many sectors able to push, again, those price increases onto consumers. You do then see the contraction of margins and those earnings estimates start to come down. So I think it's the opposite scenario is what we think is more likely to happen.
Dan Morris, thank you, sir. Good to catch up out of BNP. I bring that up after the moves we saw yesterday. GM coming off the back of its worst day of the year so far. The stock hammered this morning, for those of you interested, just about positive in the pre-market. But one to watch, the unions have got some big asks. So let's go through a few of them. They want a 46% wage increase, the restoration of traditional pensions, cost of living increases, a shorter working week, and better retiree benefits. And as one analyst said, Tom, these names right now in the penalty box until this is resolved.
That famous Bloomberg surveillance phrase, there's absolutely no alternative. We heard that at the Renaissance Center in Detroit. We were there for the upset of the auto industry. Steve Ratner, as car czar, was there on that given day as well. And there was a labor shift there, John, from my childhood in 170,000 Teamsters, blah, 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 down to something that was lower wage. The unions want a jump condition back to what they remember from their fathers and mothers. It's as simple as that.
And these brands now need to compete with Tesla. What did Tesla do yesterday? Tesla was up as they were getting hammered. And Lisa, I think we're all familiar with the why.
Yeah, and this has been the story, is that basically they have been cutting back, expanding, and they have been not tied to the unions. They have actually pushed back more aggressively. And Elon Musk has come under a lot of fire for that, including from the President of the United States. And yet here we have General Motors and Ford talking about $80 billion of costs for each of them if the UAW comes through with some of these asks. And we heard this yesterday from people who came on this show. Victoria Fernandez, she came on. She was like, listen, I'm not going to go for a company that could potentially come under pressure from the unions.
How do these brands, how do these companies, Tom, compete?
Well, they compete, but also it's almost like Disney where there's a strategic cause as well, which is, does EV work? I mean, over the weekend, into your weekend reading, folks, I'm seeing in the zeitgeist the idea that EV is 7% of the auto public. I mean, that's a small number. And Ford and GM and the rest of them, including the European makers, have to figure out how do you do the labor construct to make profit, which shareholders demand, given a seismic technological shift that's a complete mystery.
And how do you get the workers on board because they are not particularly happy with a lot of the electric vehicle
Why should they
policies?
be on board? Their real income is cratered.
Well, so here's the issue, right? Have we really reached a point where labor still has power because of just a declining working age population? And does that cause a real shrinking in margins that we haven't really seen yet, that people aren't really going to account for? Is this a name-by-name story, or is this something broader?
You didn't live it. I didn't live it. Peripheral Rochester Delco. John, you lived it. The Midlands of England was auto nation.
Yeah, not anymore.
And it disappeared.
Coventry was the heart of it, yeah.
Why did it disappear?
Coventry was the Detroit of the United Kingdom.
Why did it disappear?
You can blame a lot of things. I think most people would point to globalization, which has decimated both Detroit and the likes of Coventry.
Can we blame them?
I think we can blame them too.
Okay.
I think we can also talk about EVs not being green. Do you see the new Cadillac Escalade? Give me a break. Electric, green, good for the environment.
Yeah, the size of a building.
Shut up. From New York, this is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. In his first international media interview since becoming Taiwan's vice president, Lai Ching-te speaks to Bloomberg exclusively about his presidential run and managing relations with the U.S. and China.
Taiwan security is a global issue, and the peace in the Indo-Pacific region benefit all the country.
What kind of leader would he be? What are his plans for Taiwan? And what would they mean for the world? Tune in all day August 15th, only on Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We are at a watershed moment in our economy. And I'm not just talking about the fight against inflation, in which we are making progress.
Inflation will gradually make its way down, but it is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target.
The Federal Reserve has a dual mandate from Congress. The first is to foster stable prices. And this is why we have been working hard in recent months to reduce inflation, which has been too high, and bring it back down to our target of 2%.
Fed presidents there, Harker, Daly, Bostic, they all agree on one thing. There's more work to do. Now, whether you believe that means more interest rate increases or just holding them here for a longer period of time, I guess it's up to you, and we'll see various Fed officials take different views on that. In the equity market on the S&P 500, this rally really faded going into the close. Off the back of the inflation data, equities up. Then it started to fade as Mary Daly started to speak, and in the afternoon, we had a pretty soft issue on the 30-year maturity out of the Treasury. So 3-year went well, 10-year went okay, 30-year, in comparison, not so good. Yields up this morning, down just a touch on a 10-year, 4.0977% on a 10-year this morning. The euro really not giving me much this morning. The euro at the moment, Tom, 109.87. But if I'm in Europe, I'm looking at China. And the data out of China this morning, once again, not painting a picture of an economy that's rip-roaring and on fire right now.
There's a lot to talk about in the Asian Pacific Rim, and I'm going to go here at some point, John, to euro yen and that. But to have Steve Englander on with us to frame our FX market into the weekend is important. Global head of G10 FX Research at Standard Charter, with all sorts of wonderful Yale economics on the American economy and on the disinflation witnessed yesterday.
Steve, wonderful to catch up with you, sir. Question of the week in foreign exchange, asked by Kit Jukes of SocGen. Why is the euro not weaker given what's happening in China? Why isn't it?
I think that, the market wants to sell dollars most of the time, and it's being forced to buy dollars kind of against its will. The market is pretty long dollars. I think most investors think that the inflation is sort of disinflation is in the bag. And I think that they're waiting for the economic data to slow down so that the Fed hikes go out of the picture and the prospect of cuts come in. I would add one more thing. I mean, and this is, I think, this doesn't happen all the time, but this is like a unique situation or a relatively rare situation. Right now, the U.S. is a high yielder, and market sentiment is very risk off. So you're a safe haven and a high yielder. That's a very powerful combination in the short term. And so we have to see some action on the yield side for the selling that the market wants to do to resume.
Stephen, in your research note, you go to 6-month annualized. I thought Jason Furman at Harvard led yesterday with an interesting idea of where to look for the rate of change of disinflation that's out there. I think the key question for our listeners and viewers is, when we move, does it take forever to shift to a disinflationary central bank, or will it be, to use the economic phrase, suddenly?
Suddenly, in the Hemingway sense of the word, first slowly, then very quickly. Look, I think that the Fed isn't going to give any order until it becomes clear that the U.S. economy is slowing. They really feel comfortable riding the Phillips curve. And if they see some sign that the labor market is weakening, along with the disinflation that's obvious out there, then rate cuts will very quickly come into the picture, not slashing them down to zero, but sort of 25 here, 25 there. I think right now they don't see the upside, as Mary Daly said, in declaring victory. Even if they're right, that's not going to help them. And if they're wrong, it would be catastrophic.
Last week, everyone was talking about political risk, fiscal risk, that suddenly that would matter again for currency traders. Has it?
Well, yes, but in the wrong direction, I think, because look, I think Fitch was right to downgrade the U.S. It's very different than 2011. 2011, we came out of the debt crisis with a very strong fiscal deal that limited spending. This deal, the one that we got in May, enshrined sort of most of the spending that we had during the COVID period. Is just not going to go away. So I think that the combination of the absence of a mechanism to arrive at a fiscal outcome, plus the settings that are kind of looking in the wrong direction. Yeah, the U.S. isn't going to go bankrupt. It's always going to pay its coupons, but whether it pays it with a weaker dollar or higher inflation is the question.
So some people are attributing the recent rise in yields to this idea of political risk, of fiscal uncertainty, or fiscal, at least largesse when it comes to the debt. Other people say it's just a story about the Bank of Japan. It's just a story about money flows, not necessarily coming in the same way from that economy based on yield curve control, maybe being tweaked, maybe being abandoned. Do you agree with that?
Well, I agree with the first and not with the second. There's nothing meaningful that the Bank of Japan has done in terms of limiting the flows that they're putting into the market. Basically all they've done is that the yield go up a little bit to market rates. I think, if you look at the way the long end has been trading, given that there's no real shift in expectations of what the Fed is doing, this is all risk premium, and it's risk premium concentrated way out the curve, which tells you that it's not a specific, immediate, next week retail sales, that's going to be the problem. It's something that says, look, we're worried about the distant future, and now we're, pricing it in. And that's fiscal, I think.
Steve, I want to shift here, segue if I can, over to what traders are looking at this weekend, which is take out the dollar. Euro yen is extraordinary, 158. We had a 159 print as I walked in the door this morning. What are the ramifications for Japan, for the Pacific Rim, if we see Euro yen break out to a 160, a weaker yen? We're right at the precipice on the weekend. What's the so what here?
Well, I think that the yen spills over in competitive currencies. So it will have an impact on Korean won. It will have an impact on China, a few other currencies. I think, honestly, there's a bit of puzzlement as to what good a weaker yen is doing Japan. But, I think it just sets the tone. The market would really like to sell dollars against Asian currencies. And we think towards the end of the year, that's what's going to happen, that the risk environment will improve. But it's very hard to do as long as the, sort of yen against the dollar and yen against the crosses are pushing up against these levels. I don't think the market's piling into short yen at this stage. They're short enough. I think it's more that they're waiting to see some sign that there's stabilization there and maybe a move back. And that would, and plus an improvement in the risk environment, then the dollar selling would resume. But, I don't think it's going to happen over this weekend. I think it will take a little bit of time.
Steve, before you go, just to double confirm, triple confirm, you think the Fed's done here?
Oh, yeah. And I think there's a risk they cut faster than the market thinks. Once the data starts sliding, you kind of say, what's the point? If, labor market is weak and inflation's coming down, you've kind of won. You don't cut, you don't cut very far, but you might throw in a token cut, Q1 and to show that your heart's in the right place.
A token cut in Q1 to show your heart is in the right place. Steve, what a change from 12 months ago.
Yeah, but, they've really come off their hawkish tone. I mean, nobody's talking about that second hike in the dots. They just brush it aside if they're asked. And I think what they're doing is just trying to be sure that they're not sounding too dovish prematurely. But I think everybody reads through the comments and says, look, they're, it's a failure to commit. It's not because the data don't justify. One last thing, very quickly,
you got
take
20
a look
seconds,
at oil prices. Sure. They went up from like 65, 70, now they're north of 80. During that process, 1 year inflation expectations came down from 2 to 1.5. So, which means implicitly that core expectations have collapsed, just like we saw yesterday in the numbers, and that's likely to continue in coming months. They're in a very good spot with respect to inflation for the next 6 to 12 months.
Steve, we'll continue this conversation. Steve Englander of Standard Chartered. To show their heart's in the right place, they're going to cut in Q1. Bramo, that's quite a statement from Steve Englander this morning.
Especially when he says, what's the point? The data starts turning lower. What's the point? The point that a lot of people feel is that longer term, there still are some inflationary pressures that have yet to truly show up.
The history here is simple. They get overwhelmed by the data coming in and they have to act fast.
What a split, though. There's a conversation right now on the other side, and Lisa alluded to it, about inflation reaccelerating.
Yeah.
We'll see.
Yeah, specific components.
Or at least sticky.
Abigail Walt of Aberdeen, coming up next from New York. Good morning.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Let's get you to the weekend. I've said that twice in the last hour. I'll say it more. Let's get you to the weekend. Your equity market on the S&P 500, negative 0.1%. We're down on the week, down on the session, just a little bit. On the Nasdaq 100, we're down by 0.2% on the Nasdaq 100. Poised for the longest losing streak of the year on the Nasdaq, just pulling back once again. On a Russell, just slightly firmer, but pretty much mild moves this morning across the board. In the bond market, nothing mild about the moves yesterday. Wow, 30-year issue soft, bit of Fed pushback, yields up and away, curve steeper, bigger moves down the longer end, 10s and out. Your 10-year this morning comes in about a basis point, 4.0958% on a 10-year. On the 10-year, we're rising for a fourth straight week, fourth consecutive week, yields higher. In the FX market, the dollar